Tax evasion. Tax evasion is the deliberate act of hiding income, assets, or financial activity to avoid paying taxes, and the unsettling truth is that ultra-wealthy individuals often attempt to use their size, influence, and complexity to shield what they don't want the world to see. The core idea is simple. The less that is reported, the less that is owed. But for the ultra-wealthy, this isn't done through simple tricks. It's attempted through layers of financial fog. They operate through structures so large and confusing that it becomes difficult for authorities to see what is real and what is intentionally hidden. The ultra-wealthy who attempt tax evasion don't usually stash cash under a mattress. They exploit the complexity of global finance. They may shift money through entities in different countries, route funds through businesses they control, or hide ownership behind layers of legal paperwork. These systems are built to create distance between the individual and the income they're trying to disguise. The money doesn't disappear. It is simply buried under so many layers that finding the truth becomes a challenge. What makes this emotionally powerful is the contrast. Ordinary people pay taxes from a paycheck they never even see, while some of the wealthiest attempt to shield vast sums behind financial smoke. This gap creates a sense of unfairness that cuts deep. Every dollar hidden strengthens the imbalance between those who follow the rules and those who believe they can step outside them. The allure for the ultra-wealthy lies in the illusion of protection. When large networks of companies or accounts appear to separate them from their money, they may start to feel untouchable, insulated by wealth and complexity. This illusion fuels the belief that the system can be outmaneuvered, and when individuals with immense resources attempt tax evasion, the effects ripple outward, distorting public trust, weakening institutions, and deepening the divide between power and accountability. Money laundering. Money laundering is the process of hiding the true source of illegal or suspicious money so it appears clean, and when ultra-wealthy individuals attempt to use it, the entire operation takes on a much larger and more unsettling scale. Instead of handing off cash in small amounts, they work through vast financial structures built to blur reality. For them, laundering isn't a single act. It's a network of movement designed to make the truth vanish behind complexity. The core idea is still simple: make dirty money look legitimate, but the way it's approached at the top levels of wealth turns the process into a kind of financial camouflage. Ultra-wealthy individuals don't typically move money through obvious channels. They attempt to hide it behind companies they control, investments they influence, or assets that can hold value without raising suspicion. Their financial lives are naturally complex, and that complexity becomes the perfect hiding place. When money flows through multiple entities, accounts, or transactions, it becomes difficult for outsiders to determine what's normal and what's intentionally disguised. That confusion is the emotional heart of why money laundering feels so powerful. It turns clarity into uncertainty. What makes this especially impactful is how it affects perception. When ordinary people look at wealth, they see success, legitimacy, and respectability. But laundering turns that image into a mask. A mansion might not reveal the shadowy money behind it. A business empire might be partly built on funds no one can trace. This contrast creates a deep emotional tension. The idea that someone can present a polished, luxurious life while hiding the truth beneath layers of financial distortion. When ultra-wealthy individuals attempt money laundering, it becomes less about hiding money and more about manipulating visibility itself, shaping what the world is allowed to see and what must remain buried. Insider trading is the act of using secret, non-public information about a company to make financial decisions before the rest of the world knows what's coming. And when ultra-wealthy individuals attempt to use it, the entire dynamic becomes far more dangerous and emotionally charged. At its core, it's about having access, information that can predict a stock's rise or collapse before everyday investors ever see a headline. That information becomes a weapon, a shortcut, a way to sculpt outcomes instead of merely reacting to them. Ultra-wealthy individuals often sit close to the flow of privileged information. They sit on boards, hold executive roles, or move in networks where major decisions are whispered before they're announced. Even without intending to, they stand near the sparks that ignite market shifts. And for those who choose to cross the line, the temptation is rooted in the same idea: act before everyone else can. The emotional pull comes from the feeling of being ahead of the world, of beating the system that billions of people must follow blindly. The unsettling part is how invisible it looks from the outside. To most people, a sudden stock trade is just another blip on a chart. But when someone with immense wealth acts on inside information, those moves can look like genius, strategy, or perfect timing. Their public image grows stronger, while the truth stays buried beneath layers of influence. The success appears earned, but a hidden advantage quietly shapes the outcome. What makes insider trading feel so powerful in the hands of the ultra-wealthy is that it blurs the line between privilege and manipulation. It turns private information into a silent form of control, letting a select few shape their fortunes, while everyone else plays a game they cannot possibly win. Market manipulation. Market manipulation is the deliberate act of influencing the price of a stock, commodity, or financial asset to create an illusion that benefits the manipulator. And when ultra-wealthy individuals attempt to use it, the effect becomes far more powerful and unsettling. At its core, market manipulation is about shaping perception, convincing the world that an asset is rising, falling, or stable, even when the truth is being quietly distorted. It's psychological theater performed on a financial stage. Ultra-wealthy individuals often hold enough capital, influence, or visibility to shift markets simply by making a move. A single investment, a sudden sale, a public comment, or a strategic rumor can send waves through the system. Because they control larger volumes and have access to insider circles of analysts, executives, and institutions, their actions naturally draw attention. When someone with enormous wealth chooses to misuse that attention, the entire market becomes their canvas. Prices bend not because of real value, but because someone powerful wants them to. The emotional charge comes from how invisible it can be. To the everyday investor, the charts look normal, the swings look like chance, the momentum appears organic, but behind the scenes, someone with massive resources might be creating artificial demand, sparking fear, or pushing panic into the market to profit from reactions they deliberately triggered. What looks like a natural rise may be a setup. What looks like a crash may be engineered. What makes market manipulation so psychologically haunting is that it turns the financial world, a place people trust with their savings, dreams, and futures, into a stage for strategic illusions. Ultra-wealthy manipulators can shape the emotions of entire markets without ever being seen, making millions of people respond to movements that were never real in the first place. Pump and dump schemes. A pump and dump scheme is the engineered inflation of an asset's price followed by a sudden, calculated sell-off. And when ultra-wealthy individuals attempt to use this tactic, it becomes a psychological trap disguised as opportunity. The scheme begins with one motive: create excitement. Ultra-wealthy operators know that the average investor is guided by emotion, fear of missing out, hope for quick wealth, and trust in what appears to be sudden momentum. By quietly accumulating a cheap asset, then flooding the market with hype, endorsements, or artificial trading activity, they build the illusion that something big is happening. The public sees the rise and believes it's real. The manipulators see the rise and know they engineered it. When ultra-wealthy individuals involve themselves, the illusion becomes harder to detect. Their influence alone can give a worthless asset an aura of legitimacy. A single public statement, a large visible purchase, or the appearance of institutional interest can make people believe something valuable has been discovered. It is a psychological play. Ordinary investors trust that where wealth goes, truth follows. They chase the rise, unaware they are fueling the trap. The emotional impact comes from what happens next. Once the price has climbed high enough, fed by ordinary people who think they've caught the beginning of a breakthrough, the orchestrators quietly sell everything. The market collapses. The public loses money instantly, left stunned and confused, wondering how something that looks so promising could crash so quickly. For the ultra-wealthy manipulator, the fall is intentional. For everyone else, it feels like betrayal. What makes pump and dump schemes so disturbing is how easily excitement can be manufactured and how effortlessly trust can be weaponized. The wealthy engineer the rise, escape before the fall, and leave thousands holding the wreckage of a dream that was never real. Wash trading. Wash trading is the act of buying and selling the same asset to yourself to create the illusion of real market activity. And when ultra-wealthy individuals attempt to use it, the manipulation becomes far more potent and deeply unsettling. At its core, wash trading fabricates demand where none exists. It tricks the world into believing that an asset is popular, valuable, or gaining traction, when in reality, the only person behind the movement is the one orchestrating both sides of the transaction. Ultra-wealthy individuals have an advantage that makes this deception even more powerful: scale. With access to multiple accounts, brokers, entities, or platforms, they can create a storm of artificial activity that looks indistinguishable from genuine market interest. To an outsider, the rising prices and sudden spikes in volume appear organic, attracting real investors who believe they're catching a trend. But behind the scenes, the same money is simply cycling in a circle, building a fabricated story designed to pull others into the illusion. The emotional punch comes from how easily trust can be manipulated. People put their savings into markets, believing they reflect truth, supply, demand, value, momentum. Wash trading preys on that belief. It invites innocent investors into a trap built entirely from fake signals. What feels like opportunity is actually choreography. What looks like growth is only smoke. When ultra-wealthy individuals attempt this tactic, it becomes more than deception. It becomes influence disguised as market behavior. Their artificial trades create a narrative strong enough to move real money, shift confidence, and reshape the perceptions of thousands of investors who never realize they're responding to a performance rather than reality. Spoofing is the act of placing large fake orders in a financial market with no intention of fulfilling them. And when ultra-wealthy individuals attempt to use it, the psychological impact becomes far more intense and disruptive. At its core, spoofing is about deception, creating the illusion of supply or demand that doesn't actually exist. The manipulator pretends to move the market in one direction, triggering real investors to react, and then quietly profits when the price shifts exactly as planned. It's a financial mirage designed to influence emotion before logic can catch up. Ultra-wealthy individuals who attempt spoofing don't rely on small moves. They can place orders so large that markets twitch instantly. Traders see a wall of buying or selling pressure and panic, believing a major shift is happening. That panic becomes predictable, and the manipulator feeds off the emotional shock they create. For the wealthy, the entire market becomes a lever, one they can push with orders that look real but are meant to vanish the moment they achieve their purpose. What makes spoofing emotionally powerful is how invisible it feels to outsiders. Regular investors see only the aftermath: sudden jumps, unexplained drops, confusing volatility. They assume it's natural market movement, never realizing that someone with deep pockets may have orchestrated the chaos for personal advantage. The manipulator steps in and out of the scene without leaving a trace, making fortune building look like flawless timing instead of engineered deception. Spoofing in the hands of the ultra-wealthy becomes more than a trick. It becomes psychological manipulation on a massive scale. It exploits fear, greed, and uncertainty, making genuine traders react to ghosts in the order book. The market appears alive, but the heartbeat they're responding to was never real. Layering is a deceptive tactic where someone places orders they never intend to execute, using them to create the illusion of buying or selling pressure. And when ultra-wealthy individuals attempt to use it, the psychological and financial impact becomes far more intense. At its core, layering is about controlling perception, crafting a false story in the market, and letting everyone else react to a narrative that isn't real. It works by playing with human emotion, greed when prices seem to rise, fear when they appear to fall. The manipulator counts on those emotional reactions to move the market in their favor. For the ultra-wealthy, the scale of layering becomes more powerful because their trades naturally carry weight. Large orders placed by a major investor can trigger algorithms, alert other traders, or shift entire market moods within seconds. Even the appearance of interest from someone with immense financial power can cause waves of speculation. When that appearance is deliberately false, it becomes a psychological trap, one that pulls ordinary investors into movements created purely for someone else's benefit. The emotional impact lies in how invisible this tactic appears from the outside. Regular traders think they're witnessing genuine market activity. They see a surge of buy orders and assume demand is real. They see sudden sell pressure and believe value is collapsing. In reality, someone wealthy may be placing fake orders to push prices in a direction they want, only to cancel them once the crowd has reacted. The public ends up chasing shadows. What makes layering so unsettling when used by the ultra-wealthy is that it turns the market into a stage where power, perception, and psychology collide. Prices move not because of real value, but because someone with resources engineered a moment of confusion and profited from the emotional chain reaction it caused. Front-running is the act of using advanced knowledge of someone else's upcoming trade to place your own trade first. And when ultra-wealthy individuals attempt to use it, the entire financial landscape tilts in their favor before anyone else even realizes a shift is coming. At its core, front-running is about exploiting timing, acting on information that isn't public yet, information that predicts where the market will move because someone with significant capital is about to push it there. It's not about intelligence or strategy. It's about getting ahead of people who have no idea they're being outmaneuvered. Ultra-wealthy individuals often sit close to the heartbeat of major financial activity. They work with top-tier brokers, have relationships with institutional investors, and move within circles where huge trades are prepared before they ever appear on a screen. Even the hint of a large order can signal what's about to happen, a massive buy that could send prices up or a large sell that could drag them down. When someone privileged chooses to act on that knowledge, they slip in milliseconds before the trade hits the market and profit from a wave they never created. The disturbing part is how invisible it is. To ordinary investors, it looks like someone just made a perfectly timed move. To the ultra-wealthy frontrunner, it feels like cheating the future, claiming profit from a shift that hasn't happened yet, but is guaranteed to happen once the larger trade triggers. It creates an emotional divide because regular people invest with hope, while the frontrunner operates with certainty. What makes front-running feel so unfair is the imbalance it exposes. Everyday traders respond to market changes as they happen. Ultra-wealthy individuals who attempt front-running respond before changes even begin. turning time itself into a private advantage that everyone else is forced to lose against. Accounting fraud. Accounting fraud is the deliberate act of falsifying a company's financial records to present a picture that isn't real, and when ultra-wealthy individuals attempt to use it, the distortion becomes far more powerful and emotionally disturbing. At its core, accounting fraud is about crafting an illusion, numbers reshaped, losses hidden, profits exaggerated, all to convince the world that a business is thriving even when it's quietly falling apart. It replaces truth with a carefully engineered story written in spreadsheets instead of ink. Ultra-wealthy individuals often sit at the very top of the structures that control these numbers. They have influence over executives, accountants, and decision-makers, giving them the authority to nudge the narrative. A small adjustment here, a concealed liability there, a manipulated valuation tucked into a report. Each alteration seems minor on its own, but together they create a financial mass that can deceive investors, employees, regulators, and entire markets. People trust official documents, annual reports, and audited statements, and that trust becomes the perfect hiding place for deception. The emotional impact of accounting fraud is rooted in betrayal. Investors place their hopes and life savings into companies believing the numbers reflect reality. Employees devote years of their lives unaware that the foundation beneath them is built on doctored figures. When ultra-wealthy individuals shape those numbers to protect their own image or wealth, the consequences ripple outward, harming people who never had access to the truth. What makes this form of fraud so unsettling is how clean it looks on the surface. A polished report can hide financial rot. A strong quarter can mask fabricated success. And when the ultra-wealthy orchestrate these illusions, it becomes more than manipulation. It becomes the power to rewrite reality, using numbers as their camouflage and credibility as their shield. Securities fraud. Securities fraud is the act of deceiving investors by manipulating or misrepresenting information about stocks, bonds, or financial assets. And when ultra-wealthy individuals attempt to use it, the deception grows far more sophisticated and emotionally unsettling. At its core, securities fraud is built on a simple idea: control what people believe, and you can control where their money goes. It twists trust into a tool, turning financial markets, places people rely on for retirement, savings, and security, into a stage for calculated misinformation. Ultra-wealthy individuals who attempt securities fraud don't usually fabricate small lies. They shape narratives. They may use their status, influence, or connections to make false claims look credible. A public statement, a polished report, or a strategic omission can push investors into action without them realizing they're being guided by misinformation. Because of their resources, these individuals can make lies appear indistinguishable from truth, masking manipulation behind prestige, confidence, and professional presentation. What makes securities fraud emotionally powerful is how deeply it violates trust. Investors look at earnings reports, forecasts, and company updates with the belief that the information is accurate. When someone wealthy manipulates those signals, exaggerating profits, hiding losses, or misrepresenting performance, ordinary people end up betting their futures on fiction. Those who follow the false narrative suffer, while the manipulator quietly benefits from the illusion they created. The emotional tension intensifies when the fraud is uncovered. What seemed like brilliant success reveals itself as engineered deception. Families lose savings, markets destabilize, confidence fractures, and the ultra-wealthy individual who orchestrated it often appears untouchable until the damage is already done. Securities fraud in the hands of the powerful becomes more than dishonesty. It becomes a distortion of reality itself, reshaping what people believe long enough for someone else to profit from the fallout. Ponzi schemes. Ponzi schemes are financial illusions built on promises that can never be kept. And when ultra-wealthy individuals orchestrate or benefit from them, the psychological impact becomes far more disturbing. A Ponzi scheme works by paying old investors with the money of new investors, creating the appearance of profit where none actually exists. It's a financial mirage, a system that survives only as long as fresh money keeps flowing in. But what makes it emotionally gripping is not the mechanics. It's how deeply it plays on human hope, trust, and desperation. When an ultra-wealthy figure runs or fuels a Ponzi scheme, the illusion becomes even more convincing. Their reputation, status, and influence act like a disguise that makes the entire structure seem legitimate. People trust those who look successful. They believe someone with prestige must be offering something safe, advanced, or exclusive. That belief is the emotional fuel Ponzi schemes thrive on. The wealthy manipulator becomes the face of credibility, while behind the scenes the entire operation rots from the inside out. The power of a Ponzi scheme lies in the story it tells. Early investors receive payouts that look real, creating excitement, testimonials, and social proof that draw others in. The scheme grows like a wildfire, not because the math works, but because people want to believe they've finally found a rare opportunity. This emotional momentum is what ultra-wealthy orchestrators rely on. The larger their image, the stronger the belief, and the deeper the trap becomes. What makes Ponzi schemes especially haunting is the moment the illusion collapses. It never fades slowly, it implodes. People lose their savings, their trust, their sense of security. Real lives shatter while the architect often walks away long before the fallout hits. When someone with immense wealth manipulates hope on such a scale, the emotional damage reaches far beyond finances. Pyramid schemes. A pyramid scheme is a deceptive structure that promises wealth, but is built on nothing more than constant recruitment. And when ultra-wealthy individuals attempt to involve themselves in these systems, the psychology behind the manipulation becomes even more unsettling. At its core, a pyramid scheme survives only by pulling new people in, each layer funding the one above it, each recruit believing they've joined something exclusive and profitable. But when the ultra-wealthy enter the picture, they use their influence, image, and status to make the scheme look legitimate, drawing in victims who trust the illusion more than they understand the mechanics beneath it. An ultra-wealthy figure can transform a hollow operation into something that seems powerful. Their lifestyle, their reputation, and their public presence act as bait. People assume that if someone with immense resources is involved, the opportunity must be real. Hope becomes a vulnerability. The promise of getting in early feels believable because the face promoting it looks successful. That emotional hook is what keeps victims climbing upward, unaware that there's no real product, no real investment, just the pressure to bring in more participants. The psychological impact intensifies as the scheme grows. Early recruits see money coming in, reinforcing trust. Later recruits join out of fear that they're missing something, and the ultra-wealthy orchestrator watches the structure inflate, benefiting from the inflow while contributing nothing of actual value. Eventually, the scheme collapses under its own weight. Those at the bottom lose everything. Those at the top walk away long before the crash, insulated by the very wealth that attracted victims in the first place. The emotional sting comes from how easily ambition can be manipulated. Pyramid schemes weaponize dreams, and ultra-wealthy figures can make those dreams look more achievable than ever, even when the entire structure is destined to fall. Embezzlement is the act of secretly taking money or assets from an organization you're trusted to manage, and when ultra-wealthy individuals attempt to use it, the betrayal becomes deeper, quieter, and far more emotionally charged. At its core, embezzlement is about abusing access. It's not a dramatic theft. It's a quiet siphoning, hidden inside the routines of everyday business. It thrives on the belief that people rarely question those in positions of power. The more trust someone holds, the easier it becomes to take from the very system they're meant to protect. Ultra-wealthy individuals often occupy roles where they control massive flows of money. Fund managers, company founders, board members, executives. They sit close to the stream of financial movement, and in that position, the lines can be blurred, adjusting a transfer, redirecting funds, disguising withdrawals behind legitimate expenses. These actions can be hidden inside the noise of large operations. The privilege of authority becomes the perfect camouflage. No alarms, no force, just quiet decisions. No one notices until the damage is irreversible. What makes embezzlement emotionally disturbing is the intimacy of the violation. It isn't money stolen from strangers. It's taken from partners, employees, investors, or institutions that trusted the individual completely. People believe their leaders are safeguarding the resources that support their livelihoods, only to later discover those resources were slowly drained by someone who was supposed to protect them. The shock often comes not from the amount, but from the betrayal itself. When ultra-wealthy individuals attempt embezzlement, it becomes more than a financial crime. It becomes a distortion of trust. Their influence shields them, their status quiets suspicion, and their confidence can make the theft feel untouchable. The outward image remains polished and powerful, while beneath it lies a quiet erosion built on the belief that their position will keep the truth from ever catching up. Bribery. Bribery is the act of offering money, favors, or influence to gain an advantage that should not be earned. And when ultra-wealthy individuals attempt to use it, the entire process becomes more subtle, more calculated, and far more emotionally jarring. At its core, bribery is not about cash in an envelope. It's about bending decisions, shaping outcomes, and quietly steering people in positions of power to act in ways that benefit the giver. It transforms influence into a currency, one that can tilt justice, business, and government without leaving fingerprints. Ultra-wealthy individuals who attempt bribery rarely approach it directly. Their power lets them disguise it as opportunity. A lucrative consulting contract offered to the right person, a donation made to open specific doors, a favor that appears generous but is loaded with unspoken expectations. These exchanges feel polished, professional, even harmless on the surface, but underneath lies a strategic push designed to tilt the system in their favor. The emotional tension comes from how normal it can look, how easily a corrupt act can be wrapped in respectability. What makes this psychologically powerful is the imbalance it creates. Regular people rely on rules and fairness to navigate life, but bribery fractures that foundation. When decisions that affect thousands are influenced behind closed doors, trust collapses. The wealthy individual walks away rewarded, protected by layers of prestige, while everyone else deals with the consequences of choices that were never made honestly. Bribery in the hands of the ultra-wealthy becomes a quiet distortion of reality. A policy shifts, a contract is awarded, a legal outcome changes course. None of it looks suspicious from the outside, yet each move was nudged by hidden influence. It creates a world where outcomes feel pre-written, where those with power can tilt the future in their direction, while everyone else is left wondering why things never seem to be as fair as they appear. Procurement fraud. Procurement fraud is the act of manipulating purchasing processes to divert money, contracts, or resources for personal gain. And when ultra-wealthy individuals attempt to insert themselves into these schemes, the manipulation becomes quieter, deeper, and far more convincing. At its core, procurement fraud is about controlling who wins and who loses before the competition even begins. It twists systems meant to be fair into hidden channels that serve a select few, creating an illusion of legitimacy, while the true outcome is already predetermined. Ultra-wealthy individuals often sit near the centers of influence, corporate boards, political networks, high-value industries. When someone with immense resources chooses to exploit procurement, they don't need to falsify small documents or forge fake bids. Their power lies in subtle pressure, exclusive relationships, or the ability to steer decisions without appearing involved. They may leverage reputation, connections, or existing business empires to make their chosen contractor look like the only logical option. People trust names with wealth behind them, and that trust becomes the gateway through which manipulation flows. What makes procurement fraud emotionally striking is the betrayal hidden beneath professionalism. Contracts for hospitals, schools, infrastructure, or public services are supposed to help communities, but when someone manipulates these systems, the impact ripples outward. A cheaper but unreliable service gets chosen, quality drops, and the public pays the price for decisions they never saw being influenced. Meanwhile, the ultra-wealthy orchestrator remains distant from the fallout, protected by layers of executives, advisors, or subsidiaries that bury their involvement under formality. The unsettling truth is that procurement fraud hides behind respectability. It doesn't look like theft. It looks like a meeting, a handshake, a signature. And when someone with vast resources uses their influence to tilt the process, the fraud becomes nearly invisible, felt by many, traceable by few, controlled by one. Shell company misuse. Shell company misuse is the act of using empty, paper-only companies to hide ownership, disguise money movement, or conceal true control. And when ultra-wealthy individuals attempt to use it, the deception becomes far more layered and emotionally unsettling. A shell company looks legitimate on the surface. It has a name, an address, and sometimes even a website. But behind that thin facade is nothing. No employees, no real operations, just an empty container created to hold money in the shadows. Its power comes from invisibility, from looking ordinary while quietly serving as a mask. Ultra-wealthy individuals often exist at the center of complex financial networks. They own multiple companies, manage investments across borders, and work with teams of lawyers and advisors. Within that complexity, a shell company can blend in seamlessly. It becomes a placeholder for assets, a middleman in transactions, or a shield that hides true ownership behind layers of paperwork. To an outsider, it's nearly impossible to tell whether a company is real or simply a ghost, designed to obscure the truth. That ambiguity is the emotional core of this misuse. People trust what looks official, never realizing how easily the appearance of legitimacy can be fabricated. The unsettling part is how such a simple structure can distort reality. A mansion can be owned by a shell company instead of a person, making the true owner invisible. Money can move from one shell to another, creating the illusion of legitimate business activity when the real purpose is concealment. Entire financial trails can vanish into a maze of names that mean nothing, yet control everything. When ultra-wealthy individuals misuse shell companies, it becomes more than a financial tactic. It becomes a way to rewrite identity itself. Their public image stays polished and respectable, while the shell absorbs the shadows, holding the secrets they never want linked back to them. Straw ownership. Straw ownership is the practice of placing assets, businesses, or property in someone else's name to hide the true owner's identity. And when ultra-wealthy individuals attempt to use it, the deception becomes deeper, more polished, and far more emotionally unsettling. At its core, straw ownership is about creating distance. Distance between a person and the things they control, distance between responsibility and accountability, distance between who holds power and who appears to. It turns another human being into a shield, a placeholder used to obscure the real hand behind the asset. Ultra-wealthy individuals who attempt this tactic rarely choose someone obvious. They rely on people who blend into the background, employees, associates, or seemingly uninvolved individuals whose names are clean and unremarkable. On paper, these straw owners appear to own properties, companies, accounts, or investments, while the true controller stays comfortably hidden behind them. To outsiders, the setup looks legitimate, yet every decision, every profit, every move is dictated by the person who never appears in public records. What makes straw ownership emotionally powerful is how effectively it hides truth in plain sight. A mansion can be lived in but never legally tied to its real occupant. A company can be controlled without the controller appearing anywhere on its paperwork. A financial empire can expand quietly while the name attached to it is nothing more than a decoy. That illusion creates a haunting divide between what is visible and what is real. The psychological sting comes from the imbalance it creates. Ordinary people must claim what they own, sign their names, and accept responsibility. But when someone with immense wealth attempts to use straw ownership, they can control vast assets while remaining invisible. It creates a world where power hides behind masks, where influence is exercised through shadows, and where the truth feels just out of reach, buried beneath names that were never meant to hold the weight they carry. Beneficial ownership concealment. Beneficial ownership concealment is the act of hiding the true person who actually owns or controls an asset, company, or bank account. And when ultra-wealthy individuals attempt to use it, the deception becomes far more sophisticated and emotionally unsettling. At its core, this tactic is about creating distance between the person who truly benefits from the money and the public record that is supposed to reveal the truth. Instead of appearing as the owner, they place the asset under someone else's name, another company, or a chain of layered entities. It creates an illusion where the real power stays hidden behind a mask of paperwork. For the ultra-wealthy, concealment becomes easier because they can afford complexity. They can create webs of corporations spread across multiple countries, each one owned by another, designed to blur the line between what is real and what is strategically buried. The emotional impact comes from realizing how invisible a person can become when they have the resources to disappear behind legal structures. From the outside, a mansion, a business, or a luxury asset might look ownerless or vaguely held by a company no one has ever heard of. But behind that shell sits someone who prefers their influence to exist without a name attached. The unsettling part is how this concealment shapes perception. When ownership is hidden, responsibility dissolves. Wealth appears without explanation. Influence moves without accountability. Decisions are made by people the public cannot identify, leaving communities vulnerable to unseen forces. It creates a quiet power imbalance. Ordinary people live under full visibility. Tax returns, employment records, addresses, while the ultra-wealthy can make themselves ghosts in the financial system. What makes beneficial ownership concealment emotionally powerful is the realization that transparency is not equal. Some people can step into the shadows of their own wealth, shaping environments, markets, and decisions without ever being recognized as the ones pulling the strings. Undeclared offshore accounts. Undeclared offshore accounts are financial holdings kept hidden from tax authorities, and when ultra-wealthy individuals attempt to use them, the secrecy becomes a powerful weapon that distorts the idea of transparency itself. At its core, the tactic relies on one simple idea. If the account is far enough away, buried behind another country's privacy laws, then the money inside becomes invisible to the systems meant to monitor it. The ultra-wealthy don't see offshore accounts as distant vaults. They see them as shadows that protect their wealth from scrutiny. When someone with immense resources chooses to hide money offshore, they take advantage of places specifically designed for financial anonymity. These jurisdictions often offer strict secrecy, minimal disclosure requirements, and banking systems built to keep outsiders at a distance. To the ultra-wealthy, This feels like stepping behind a curtain where their assets no longer need to answer to anyone. What makes it emotionally unsettling is how ordinary this can look from the surface. They may maintain luxurious homes, companies, and investments, while significant portions of their wealth lie quietly in accounts no one knows exist. The psychological impact deepens when you consider that offshore money isn't idle. It can fund influence, shape business decisions, or buy assets while remaining hidden. The ultra-wealthy who attempt this practice can move money without leaving the fingerprints others are forced to show. The contrast creates a sharp emotional divide. Everyday people have taxes taken directly from their paychecks, while someone with vast wealth can shift millions beyond view with paperwork, distance, and the illusion of legitimacy. Undeclared offshore accounts reveal how easily visibility can be manipulated. What looks like financial success may be incomplete. What looks accountable may be partially concealed. And when the ultra-wealthy use secrecy as a shield, the truth becomes something only they are allowed to see. Trade-based illicit finance is the act of using everyday international trade, shipments, invoices, and cross-border deals to hide the movement of money. And when ultra-wealthy individuals attempt to use it, the manipulation becomes far more sophisticated and emotionally unsettling. At its core, this method relies on something everyone assumes is honest. Trade goods move, paperwork is filed, payments are made, and no one questions it because global commerce is enormous and complex. That complexity becomes the perfect hiding place. When a shipment leaves one country and enters another, the numbers written on the invoice determine everything, and those numbers can be quietly distorted. Ultra-wealthy individuals often operate in industries where high-value goods, global suppliers, and cross-border logistics are normal. This gives them access to a system where a single inflated price, reduced valuation, or falsely documented shipment can disguise large amounts of money without attracting immediate attention. A simple container, a routine transaction, a normal payment between two companies can hide something far darker beneath its surface. In a world where millions of goods move daily, suspicious activity blends into the noise. The emotional weight comes from how invisible it feels. People imagine illicit finance happening through secret accounts or hidden cash, not through regular business paperwork. But trade-based schemes allow wealth to move in plain sight, protected by the overwhelming size of global commerce. A mispriced shipment can appear harmless. A fake transaction can look like ordinary business. Meanwhile, real communities suffer when illicit money passes through ports and companies that should be contributing to legitimate growth. When ultra-wealthy individuals engage in trade-based illicit finance, it becomes more than manipulation. It becomes a distortion of trust in the very system that keeps the world connected. Goods move, money flows, and behind the appearance of normal commerce lies a carefully constructed deception built to make the truth disappear within the machinery of global trade. Over-invoicing. Over-invoicing is the act of deliberately inflating the price of a product or service far beyond its true value. And when ultra-wealthy individuals attempt to use it, the manipulation becomes disturbingly strategic and far-reaching. At its core, over-invoicing is about creating false numbers that look legitimate. A transaction that should cost one amount is recorded at a much higher one, and the excess becomes a hidden channel for moving or disguising money. It turns paperwork into a weapon, ordinary invoices into tools of quiet financial distortion. Ultra-wealthy individuals who attempt over-invoicing don't simply inflate a small bill. They weave it into large, complex deals where the inflated amount blends into the noise. When a multi-million-dollar project has dozens of moving parts, an exaggerated cost can hide in plain sight. These individuals may position trusted companies, partners, or intermediaries to report inflated prices, while the extra funds quietly shift into places they want them to go. To outsiders, everything looks like standard business. The paperwork matches, the transaction appears routine, yet the numbers are carefully constructed illusions. What makes over-invoicing emotionally powerful is how deceptively simple it looks. A single number, just a line on an invoice, can move massive amounts of money without raising suspicion. Ordinary people see transactions as straightforward. You pay the real cost. But in the world of the ultra-wealthy, a transaction can be a disguise, a method of rerouting value through a perfectly normal-looking document. The psychological impact deepens when you consider how often inflated prices go unnoticed. When someone with immense wealth manipulates numbers, it reinforces the idea that financial reality is flexible for those who know how to bend it. Over-invoicing becomes more than a financial distortion. It becomes a quiet rewriting of truth. Hidden behind paperwork, everyone assumes is honest. Under-invoicing. Under-invoicing is the deliberate act of claiming that goods or services are worth far less than their true value, and when ultra-wealthy individuals attempt to use it, the manipulation becomes deeper, more calculated, and far more emotionally unsettling. At its core, under-invoicing is about shrinking the truth, presenting a transaction as smaller than it really is, so the financial trail looks harmless, insignificant, or unimportant. By lowering the declared value, the real money involved disappears into the shadows, creating a gap between what is documented and what actually changes hands. When the ultra-wealthy attempt to use under-invoicing, it often hides inside massive international trade flows, high-value assets, or business deals that already appear complex to the outside world. The wealth and influence they possess make the deception look ordinary. A multi-million-dollar shipment listed for half its value doesn't raise immediate suspicion because large transactions already come wrapped in layers of accounting and logistics. That's where the emotional weight lies, seeing how easily huge sums can slip quietly through the cracks while everything appears routine on paper. The unsettling part is how under-invoicing distorts entire systems. When an ultra-wealthy individual declares an artificially low value, they may pay far less tax, avoid duties, or shift money across borders with minimal scrutiny. Meanwhile, honest businesses must compete fairly, paying full costs and facing tighter margins. This invisible imbalance creates a silent frustration. The rules feel rigid for most people, yet flexible for those who can afford complexity. The emotional tension grows when you realize how much power hides inside an invoice. A few numbers typed differently can redirect wealth, reshape competition, and reinforce advantages that already favor the powerful. Under-invoicing in the hands of the ultra-wealthy becomes more than a financial tactic. It becomes a quiet manipulation of reality, a way to rewrite the truth while showing the world only the version that benefits them. Multiple invoicing is the act of issuing more than one invoice for the same shipment, service, or transaction to move or disguise money. And when ultra-wealthy individuals attempt to use this tactic, the manipulation becomes more polished, more calculated, and disturbingly harder to detect. At its core, multiple invoicing is a financial illusion, one real event replicated on paper until it appears to justify large sums flowing across borders. The power of this scheme lies in how ordinary it looks. Invoices are common, routine, bureaucratic documents. Most people never question them. Ultra-wealthy figures understand that, and some may attempt to hide transactions behind paperwork that seems harmless. When someone with significant resources chooses to exploit this tactic, they don't rely on sloppy duplicates. They leverage entire networks, subsidiaries, partner companies, overseas entities to make each invoice look legitimate. From the outside, these documents appear unrelated, filed in different places, processed by different teams. The illusion becomes stronger because wealth adds credibility. A well-known company or high-status individual rarely triggers suspicion, allowing the duplicate paperwork to slide smoothly through financial systems designed to trust established names. The emotional sting comes from how easily reality can be rewritten when money and influence are involved. A single shipment might be presented multiple times on paper, each version used to justify new transfers of money. Those transfers can disappear into complex financial structures, leaving no obvious trail. Meanwhile, everyday people must justify every deposit, every paycheck, every small discrepancy, while someone powerful manipulates the system with documents that look perfectly official. What makes multiple invoicing so disturbing is the quietness of it. It doesn't look like crime. It looks like paperwork. It looks like accounting. It looks like business as usual. And when the ultra-wealthy attempt to use it, they turn simple documents into a veil that hides the truth behind layers of legitimacy no one thinks to question. Fictitious shipments. Fictitious shipments involve creating the illusion of goods being traded when nothing is actually being moved. And when ultra-wealthy individuals attempt to use this tactic, the deception becomes far more elaborate and emotionally jarring. At its core, a fictitious shipment is a ghost transaction, paperwork, invoices, and records that show a product was shipped, sold, or delivered, even though no container was ever packed. It is a financial illusion presented as legitimate trade, and because global commerce relies heavily on trust in documentation, the lie can blend in with millions of real transactions. Ultra-wealthy individuals often operate within international networks where trading companies, logistics firms, and cross-border partnerships are common. That environment becomes the perfect stage for creating shipments that exist only on paper. A fake bill of lading, a fabricated export record, or a forged customs document can give the impression of movement that never happened. The larger and more complex the individual's business operations are, the easier it becomes for these phantom transactions to hide inside the flow of normal activity, unnoticed and unquestioned. The emotional impact comes from the eerie simplicity of it. People imagine criminal finance happening in dark alleys or secret meetings, not inside official documents stamped and filed by systems built to handle global trade. A fictitious shipment looks official, respectable, and completely ordinary. It creates a financial trail that appears real, allowing money to move across borders under the disguise of commerce that never occurred. The deception is powerful because it lives inside a system the world depends on every day. When ultra-wealthy individuals use fictitious shipments, the manipulation becomes more than paperwork. It becomes a way to bend the global trade system to their will. Money moves, records show activity, and yet, in reality, nothing ever happened except the construction of a lie hidden within the machinery of international business. Sanctions evasion. Sanctions evasion is the act of deliberately bypassing government-imposed restrictions on trade, finance, or movement of assets. And when ultra-wealthy individuals attempt to use it, the strategy becomes far more elaborate, global, and emotionally unsettling. At its core, sanctions evasion is about finding ways around barriers that were designed to limit power. Instead of being stopped by restrictions meant to control harmful behavior, the individual searches for cracks in the system, places where rules don't align, where countries disagree, or where oversight is weak enough to slip through unnoticed. Ultra-wealthy individuals who attempt sanctions evasion rarely act alone. They build networks. They use layers of companies, intermediaries, and jurisdictions to disguise who is truly behind a transaction. A restricted person might route business through a friendly associate in another country. A banned asset could be transferred under a new name. A shipment could be relabeled before crossing a border. Each step is crafted to blur the line between what is forbidden and what appears perfectly legal. The emotional impact comes from how clean it all looks on paper. documents stamped, contracts signed, transactions neatly recorded, while the truth hides beneath a mountain of intentional misdirection. What makes sanctions evasion especially powerful is the illusion it creates. To the public, sanctions seem like firm, immovable rules, but in the hands of someone with vast wealth and deep connections, those rules can begin to feel flexible, porous, almost optional. The ultra-wealthy individual gains a quiet advantage. They can keep accessing markets, luxury goods, or financial systems that the law says they should not touch. This creates a psychological divide that is hard to ignore. Ordinary people face restrictions directly, but someone with immense resources can bend international boundaries without ever appearing involved. Sanctions evasion becomes a shadowy form of influence, reshaping what is possible simply by hiding behind the global maze of paperwork, borders, and loopholes. Export control evasion. Export control evasion is the deliberate attempt to bypass laws that restrict the transfer of sensitive goods, technologies, or information across borders. And when ultra-wealthy individuals attempt to use it, the deception becomes far more strategic, layered, and emotionally unsettling. At its core, export controls exist to prevent dangerous or high-risk items from falling into the wrong hands. Everything from advanced electronics to military-grade components. Evasion happens when someone tries to disguise the true destination, purpose, or recipient of these restricted items, turning global safety rules into an obstacle to quietly work around. For the ultra-wealthy, evasion doesn't look like smuggling in dark alleys. It hides behind polished corporations, respectable intermediaries, and international networks designed to make every shipment appear harmless. They may attempt to route goods through jurisdictions that attract less scrutiny, or disguise the end user behind layers of shell companies, making it seem as if the exports are destined for ordinary businesses instead of restricted buyers. The emotional impact comes from realizing how easily complexity can be used as a cloak. A shipment can travel halfway across the world, passing through multiple hands, each step making the truth harder to see. What makes export control evasion especially haunting is how deeply it relies on invisibility. To the outside world, the trade appears legitimate. Documents look official. Companies look normal. But behind those layers sits a deliberate attempt to bypass protections designed to prevent instability, conflict, or harm. When an ultra-wealthy individual hides behind corporate structures, they gain the ability to influence global supply chains without their name ever appearing on a form. The unsettling truth is that export control evasion doesn't just shift money, it shifts power. It allows someone with immense resources to quietly redirect restricted technology across borders, shaping consequences that most people never see, while the real decision-maker remains hidden behind a carefully constructed facade. Smurfing, structuring deposits. Smurfing, also known as structuring deposits, is the practice of breaking large sums of money into smaller amounts to avoid triggering financial reporting requirements. And when ultra-wealthy individuals attempt to involve themselves in this tactic, the manipulation becomes more calculated, more disguised, and emotionally unsettling in its quiet efficiency. At its core, smurfing relies on exploiting the thresholds banks use to detect suspicious activity. The idea is disturbingly simple. If a large deposit attracts attention, then many smaller deposits can slip by unnoticed. But for the ultra-wealthy, this isn't done by walking into banks with stacks of cash. It is done through networks, people, accounts, businesses, and financial channels scattered across different locations. When someone with immense resources chooses to engage in this kind of behavior, they rarely move the money themselves. Instead, they may rely on intermediaries, employees, or associates who make small transactions that look ordinary. Each deposit appears harmless on its own, blending into the noise of daily banking, yet together they create a pattern designed to mask a much larger sum. The unsettling part is how normal these transactions look. They don't resemble crime. They resemble everyday financial activity carried out by people who seem to be minding their own business. The emotional weight behind smurfing comes from the imbalance it exposes. Ordinary individuals are constantly monitored by automated systems, algorithms, and bank rules that flag even minor anomalies. Meanwhile, ultra-wealthy figures who attempt smurfing can hide large flows of money through layers of people and accounts that diffuse suspicion until the bigger picture disappears. It creates a quiet kind of unfairness, a sense that some can simply step around oversight by splitting their actions into pieces too small for most systems to see. What makes smurfing so haunting is the invisibility of it. Nothing flashy, nothing dramatic, just tiny movements repeated over time until the truth is hidden beneath a pattern that looks perfectly ordinary. Structuring withdrawals. Structuring withdrawals is the deliberate act of breaking large amounts of money into smaller, less noticeable pieces to avoid triggering scrutiny. And when ultra-wealthy individuals attempt to do this, the tactic becomes more complex, more hidden, and emotionally unsettling. At its core, structuring is about slipping under the radar, moving money in amounts that appear harmless, ordinary, and unimportant. It relies on the belief that small movements won't draw attention, that the system only watches for big, obvious events. This creates a quiet flow of transactions designed to look innocent while serving a far different purpose beneath the surface. Ultra-wealthy individuals may operate through multiple accounts, business entities, or financial channels, and that breadth gives them plenty of places to disguise these smaller withdrawals. To the outside world, the activity may seem like routine financial management, normal transfers, regular expenses, predictable withdrawals. But beneath that appearance, individual pieces can add up to something far larger, carefully divided to avoid raising alarms. The scale of their financial world becomes the perfect camouflage, a place where suspicious movements can vanish into the background noise of legitimate wealth. The emotional weight lies in how ordinary it all looks. People imagine financial wrongdoing happening through dramatic moments, a suitcase of cash, a risky offshore move, but structuring thrives on subtlety. It replaces drama with quiet repetition. It hides intention behind everyday behavior. The deception is unsettling because the transactions appear so normal that no one would suspect a larger purpose behind them. When ultra-wealthy individuals use structuring withdrawals, it becomes more than breaking up amounts. It becomes a manipulation of perception. Their wealth lets them blend questionable activity into a sea of legitimate transactions, creating a financial environment where small movements feel too insignificant to question, even though together they form a pattern designed to conceal the truth. Cash-intensive business abuse. Cash-intensive business abuse is the practice of using businesses that naturally deal with large amounts of physical cash, restaurants, nightclubs, convenience stores, car washes, as a cover to disguise the true origins of money. And when ultra-wealthy individuals attempt to use it, the facade becomes far more polished, calculated, and emotionally disturbing. At its core, this tactic exploits a simple truth. Cash is hard to trace. When a business already handles piles of it every day, adding more into the stream can look perfectly normal from the outside, even when the extra money has nothing to do with real customers or legitimate sales. Ultra-wealthy individuals who attempt this kind of abuse rarely own these businesses directly. They might place them under holding companies or associates so they appear to be just another investment. The business looks ordinary, employees working, customers coming and going, daily transactions flowing. But behind the scenes, the numbers are engineered. Illicit money is quietly blended into real revenue. Inflated sales figures mask the extra cash, and financial reports become a carefully crafted illusion. To regulators and the public, The operation seems successful. In reality, it's a stage designed to hide what shouldn't be seen. What makes this emotionally powerful is how invisible the manipulation feels. A family buys coffee at a cafe unaware that the shop is being used to disguise vast sums of hidden money. A neighborhood laundromat looks like a humble local business, while in the shadows, its books are being inflated by someone with immense resources. Ordinary people see honest work. The ultra-wealthy abuser sees a convenient mask. The psychological impact deepens when you realize how effortlessly legitimacy can be imitated. Cash-intensive business abuse turns everyday establishments into quiet shields, allowing someone with wealth and strategy to make illicit funds appear ordinary by burying them inside the noise of daily life. Black market peso exchange. The black market peso exchange is an underground system used to move money across borders without detection, and when ultra-wealthy individuals attempt to use it, the secrecy becomes even more layered, global, and emotionally disturbing. At its core, this scheme works by converting money in one country into pesos or another local currency through unofficial brokers who operate outside banks and government oversight. It bypasses the financial system completely, turning cash flows invisible while giving the illusion of legitimate trade. For the ultra-wealthy, the process hides behind international business operations, import-export companies, and luxury goods that already seem complex to outsiders. They may direct funds into the system through seemingly normal commercial transactions, letting underground brokers absorb illegal or untraceable money on one side and release clean, usable funds on the other. The emotional weight comes from how quietly this mechanism operates. No wire transfers, no suspicious bank records, no obvious trail, just a silent financial exchange that slips through the cracks of two economies at once. What makes this particularly unsettling is how it blurs the line between real commerce and shadow finance. Legitimate shipments may travel alongside manipulated invoices, while authentic products become tools in a hidden currency trade. To the public, it looks like ordinary business: containers on ships, trucks crossing borders, payments between companies. But beneath that facade lies a system that can move millions without anyone seeing the true origin or destination of the money. The psychological impact deepens when you realize that the ultra-wealthy, who already benefit from global mobility and influence, can use this underground exchange to move value with even less visibility than ordinary people. It turns international trade into a smokescreen, letting powerful individuals shift wealth across continents while staying completely detached from the transactions themselves. The world sees containers and paperwork. The truth disappears into a shadow network designed to keep real intentions hidden. Hawala misuse. Hawala misuse occurs when an informal value transfer system designed for trust, community, and speed is twisted into a hidden channel for moving money without oversight, and when ultra-wealthy individuals attempt to exploit it, the secrecy becomes deeper, quieter, and far more emotionally jarring. At its core, Hawala is simple. Money doesn't physically move. Instead, trusted intermediaries settle debts across borders based on verbal agreements and reputation alone. It's fast, discreet, and rooted in personal trust rather than institutional tracking. But when someone with immense wealth decides to misuse this system, the very trust that makes Hawala helpful becomes the shield that hides their intentions. Ultra-wealthy figures who attempt to exploit Hawala don't walk into small shops or hand over envelopes. They leverage influence, long-standing networks, or powerful intermediaries who already operate within the system. The entire exchange becomes invisible to the formal banking world. No wire transfers, no bank statements, no trail, just a private agreement between people who prioritize loyalty over transparency. What makes this emotionally unsettling is how effortlessly large sums can move across continents without anything appearing on record. To the outside world, nothing happened, yet fortunes have shifted behind closed doors. The psychological tension grows when you consider how this contrasts with everyday financial life. Most people must answer for every paycheck, every transfer, every minor irregularity. Meanwhile, someone with extreme wealth can exploit a centuries-old, trust-based system to reroute money in ways that bypass scrutiny. This creates an imbalance that feels almost unreal, a system built on honor being used to hide what should be seen. What makes Hawala misuse particularly haunting is the silence surrounding it. No paperwork, no digital footprints, no visible movement, just trust turned into a tool of invisibility. And when the ultra-wealthy attempt to employ that invisibility, they turn an ancient system into a shadow pathway. Only they are privileged enough to walk. Token mixing. Token mixing is the use of digital tools to obscure the path of cryptocurrency, blending transactions together until the original source becomes almost impossible to recognize. And when ultra-wealthy individuals attempt to use it, the distortion becomes deeper, more technologically hidden, and emotionally unnerving. At its core, token mixing is about erasing footprints. In the physical world, a trail can be followed. In the digital world, a blockchain shows every movement. Token mixing exploits the belief that technology can mask those movements if the trail becomes tangled enough. Ultra-wealthy individuals often operate within vast digital ecosystems, multiple wallets, custodial accounts, investment platforms, and private networks. This scale gives them more places for transactions to blend in. When they attempt to use token mixing, it isn't a single wallet sending a single transaction. It's a web of movements woven into the global flow of crypto activity. The normal chaos of blockchain traffic becomes the perfect cover, a storm of numbers that hides intention behind complexity. Outsiders see activity, but not purpose. They see movement, but not meaning. What makes token mixing emotionally unsettling is the illusion of transparency. Blockchain technology is supposed to be open, traceable, impossible to manipulate, yet token mixing bends that promise. It creates a swirl of transfers where identity dissolves and digital footprints blur into static. For ordinary users, a transaction is clear and simple, but for someone with influence, resources, and access to complex digital tools, the blockchain becomes a place where truth can be scattered into noise. When ultra-wealthy individuals attempt token mixing, the act becomes more than obscuring cryptocurrency. It becomes a way to rewrite visibility in a system designed to be unhideable. Funds move, identities dissolve, and what should be a transparent ledger becomes a maze of digital shadows built to conceal what lies at the center. Cryptocurrency tumbling. Cryptocurrency tumbling is the process of mixing digital coins with countless other transactions to blur their origin, and when ultra-wealthy individuals attempt to misuse it, the operation becomes far more complex, coordinated, and emotionally unsettling. At its core, tumbling takes advantage of the public belief that blockchain is transparent and traceable. In reality, the blockchain only shows movement, not identity, and tumbling exploits that gap by shattering a clear trail into fragments that no longer resemble the path the money originally took. Ultra-wealthy individuals who attempt to misuse tumblers do not simply send coins into a single mixing pool. They may route them through layers of wallets, exchanges, intermediaries, and automated smart contract systems designed to scramble the trail until it becomes a chaotic maze. The process looks like noise on a digital ledger, thousands of tiny movements occurring in seconds, masking the original source behind a storm of activity that feels impossible to untangle. The emotional weight of this comes from how silent it is. No suitcases of cash, no offshore trips, no private meetings, just code quietly shifting power in the shadows of a digital world. What makes tumbling so psychologically powerful is how easily it can mimic legitimate activity. To an ordinary person, every blockchain transaction looks similar, numbers moving from one address to another. But behind the scenes, an ultra-wealthy manipulator may be breaking a fortune into microscopic pieces, scattering them across the network, and reassembling them somewhere new, looking cleaner than before. The entire transformation feels invisible, like watching footprints vanish in the sand seconds after they're made. The unsettling truth is how quickly digital anonymity can rewrite reality. Cryptocurrency tumbling turns financial history into static, fragmented, unreadable, and deliberately confusing, giving the powerful a mask made not of paper or false names, but of code that hides their steps inside the endless noise of the blockchain. Privacy coin abuse. Privacy coin abuse happens when someone uses digital currencies built for anonymity, like Monero or Zcash, not for legitimate privacy, but to hide the origins or destinations of money. And when ultra-wealthy individuals attempt to use it, the secrecy becomes deeper, more calculated, and emotionally unsettling. Privacy coins are designed to protect financial anonymity, masking wallet addresses, transaction amounts, and the flow of funds. But in the hands of someone with immense resources, that anonymity becomes a tool for burying financial truths beneath layers of encrypted silence. For the ultra-wealthy who attempt to misuse privacy coins, the tactic often hides behind the appearance of technological sophistication. They can move funds between wallets, exchanges, and offshore entities in ways that look like normal digital asset activity, when in reality the system is being used to conceal ownership and bypass transparency. What makes this emotionally impactful is how effortlessly the mask can be applied. The blockchain, which many people think is perfectly traceable, suddenly becomes a maze where entire fortunes vanish into strings of encrypted code. The unsettling part is how invisible the abuse becomes. Traditional banking offers clues: names, statements, transfers, signatures. Privacy coins erase all of that. Transactions move across the world without leaving familiar footprints, allowing ultra-wealthy individuals to distance themselves from the money they control. To the public, it looks like digital noise, anonymous wallets interacting with each other. But behind those silent movements can be someone with influence, power, and an understanding of how to use technology as a shield. What makes privacy coin abuse so emotionally charged is the imbalance it reveals. Ordinary people struggle to hide even minor financial details, while someone with vast wealth can use advanced anonymity tools to move millions without revealing who they are. It turns money into a ghost, present, powerful, impactful, yet nearly impossible to identify, leaving the world guessing who truly holds the strings behind each invisible transaction. Illicit peer-to-peer transfers. Illicit peer-to-peer transfers involve using direct, person-to-person money movements to hide the true origin or purpose of funds. And when ultra-wealthy individuals attempt to exploit this method, the simplicity becomes its most dangerous feature. At its core, peer-to-peer transfers look harmless, just people sending money to each other, the digital equivalent of handing cash across a table. But when someone with immense wealth chooses to use this channel for hidden financial activity, the informality becomes a mask that conceals what should be visible. Ultra-wealthy individuals don't rely on single apps or casual, one-off transactions. Instead, they may attempt to construct webs of transfers that move quietly through associates, employees, distant contacts, and digital platforms scattered across different countries. Each transfer seems ordinary on its own, small, personal, forgettable, but together, these movements can shift large amounts of money beneath formal oversight, blending into everyday digital noise. That's what makes it emotionally unsettling. Nothing about it looks suspicious. It looks like friends reimbursing each other, families helping each other, or colleagues sharing expenses. The psychological impact deepens when you realize how differently ordinary people and the ultra-wealthy experience financial scrutiny. Regular users are flagged for unusual activity, questioned about irregular payments, or limited by platform rules. Yet someone with significant resources can attempt to break their movements into dozens or hundreds of tiny transfers routed through people who appear completely unrelated. The disguise becomes human, not just financial. Trusting faces, familiar names, innocent profiles that seem impossible to question. What makes illicit peer-to-peer transfers so disturbing in the hands of the ultra-wealthy is how human it looks. There are no shell companies, no offshore accounts, no corporate paperwork. Just people, just movement, just digital interactions that appear normal. And in that normality, hidden money slips through systems designed to catch everything except what looks ordinary enough to ignore. Dark web financial activity. Dark web financial activity involves using hidden online networks to move money, buy illicit services, or hide financial behavior behind layers of anonymity. And when ultra-wealthy individuals attempt to use it, the entire process becomes more calculated, insulated, and emotionally disturbing. At its core, the dark web is a digital underworld, accessible, obscured, and designed to disconnect identity from action. It thrives on invisibility. People enter it not through normal browsers, but through encrypted pathways meant to erase footprints. For the average person, the dark web feels like a distant rumor. For those with immense resources, it becomes a shadowed arena where transactions can be disguised behind technology built to hide the truth. Ultra-wealthy individuals have access to cybersecurity teams, private networks, and advanced digital tools that make their presence harder to trace. If they attempt to use the dark web, they can blend into a world already filled with anonymity. Their transactions don't appear in public ledgers or bank statements. They dissolve into encrypted marketplaces, private forums, and hidden exchanges where financial movements become nearly impossible to link back to a real identity. The scale of their wealth lets them move larger amounts without collapsing into visibility, allowing their presence to merge with the noise of countless unknown actors. What makes dark web financial activity emotionally intense is the collision between two worlds: the polished, sophisticated image the ultra-wealthy present to society and the hidden digital corridors where their attempted movements can vanish behind layers of encryption. The contrast is unsettling. People imagine the dark web as a place filled with anonymity seekers, hackers, and criminals, not a place where powerful individuals might attempt to hide financial behavior behind a mask of digital shadows. When ultra-wealthy individuals engage in dark web financial activity, it becomes more than using hidden networks. It becomes a way of stepping into a world where identity dissolves, oversight breaks down, and money moves through silence rather than systems, leaving the rest of the world unaware of what truly unfolds behind encrypted walls. False reporting of income. False reporting of income is the deliberate act of lying about how much money is earned, and when ultra-wealthy individuals attempt to use it, the manipulation becomes far more calculated, layered, and emotionally gripping. At its core, false reporting is about rewriting financial reality, shrinking what should be declared, expanding what shouldn't exist, or reshaping numbers until they tell a story that benefits the person controlling them. It takes something as simple as a number on a form and transforms it into a shield against accountability. Ultra-wealthy individuals who attempt this tactic do not usually alter a single paycheck or hide a small deposit. They control companies, investments, trusts, and entities that generate streams of income too complex for the average person to track. Through these structures, they may understate profits, exaggerate losses, or shift earnings where they appear smaller, or disappear altogether. On paper, everything looks professional. Statements appear polished. financial reports seem credible, yet behind the carefully constructed numbers lies a narrative designed to hide the true scale of wealth being generated. What makes this emotionally powerful is the contrast between appearance and truth. Ordinary people report every dollar they earn because they have no choice. Their income is visible, traceable, and directly tied to their survival. But someone with immense wealth can manipulate the surface so convincingly that their financial world seems smaller than it really is, creating an illusion of fairness while quietly preserving vast sums in the shadows. The psychological sting comes from how believable the fiction becomes. Numbers don't lie unless someone with enough resources writes them. False reporting of income turns financial documents into masks, hiding the real flow of wealth behind tidy spreadsheets and formal signatures. To the outside world, everything looks compliant, yet beneath the ink lies a different story, one shaped by the power to decide which parts of the truth the world is allowed to see. Cross-border tax arbitrage abuse. Cross-border tax arbitrage abuse occurs when someone exploits the differences between countries' tax systems to avoid paying what they owe, and when ultra-wealthy individuals attempt to use it, the manipulation becomes broader, more calculated, and emotionally unsettling. At its core, this tactic relies on one simple idea: different countries treat income, assets, and transactions differently. By positioning money in the right places at the right moments, someone can shrink their tax burden in ways ordinary people could never access. It's not about moving cash, it's about moving the story around the cash. For the ultra-wealthy, the scale expands dramatically. They may use multinational companies, cross-border partnerships, and global investment structures to create a financial maze where income appears in low-tax locations while expenses magically surface in high-tax ones. From the outside, everything looks legal and orderly, wrapped in contracts and filings that seem professional. But beneath those layers is a strategy built to exploit mismatches in tax rules so effectively that the true financial picture becomes nearly impossible to follow. The emotional impact comes from realizing how easily someone with immense resources can shift their financial identity depending on which country offers the most favorable treatment. The unsettling part is how invisible this abuse appears to society. Ordinary taxpayers operate within one system. The ultra-wealthy can maneuver through many, picking and choosing jurisdictions like stepping stones across a river. They shape their financial reality through geography, turning borders into tools rather than boundaries. What looks like smart planning on paper can quietly drain public resources, schools, healthcare, infrastructure, while the individual behind the structure grows richer without ever appearing to take anything. What makes cross-border tax arbitrage abuse emotionally powerful is the imbalance it exposes. Most people pay taxes automatically, without loopholes or options, while a select few can bend global systems to minimize their obligations, hiding behind complexity that shields them from the accountability everyone else must face. Bearer share misuse. Bearer share misuse involves exploiting physical share certificates that belong to whoever holds them, making ownership nearly impossible to trace. And when ultra-wealthy individuals attempt to use this method, the anonymity becomes incredibly powerful and deeply unsettling. At its core, bearer shares are designed like financial ghosts. No name attached, no registration, no record of who truly owns the company behind them. Whoever physically possesses the certificate controls the entity, and that simplicity creates an extraordinary opportunity for secrecy. When ultra-wealthy individuals choose to misuse bearer shares, they treat them as keys to invisible ownership. A company can exist on paper with no clear link to the person pulling the strings. The individual can move the certificate across borders, store it in private vaults, or hand it off to trusted intermediaries, all without creating a digital or legal trail. To the outside world, the company appears ownerless, drifting behind layers of corporate formality. That illusion of absence becomes its own form of protection. The emotional impact comes from the way this silence bends perception. Publicly, the ultra-wealthy figure might appear transparent, accountable, or detached from certain assets. Privately, a single piece of paper locked away in a discreet location may grant them control over companies, properties, or accounts no one can connect to them. Everyday people have every financial move documented, tracked, and verified, while someone with immense resources can hide their influence behind a slip of paper that effectively erases their fingerprints. What makes bearer share misuse so haunting is the fragility and power intertwined. A certificate that could fit in a jacket pocket can represent millions in hidden control. No signatures, no logs, no names, just possession. And when the ultra-wealthy use that invisibility to shield what they don't want the world to see, the truth becomes something that can be held, hidden, and passed from hand to hand without ever being recorded. Nominee director misuse. Nominee director misuse is the act of placing someone's name as the official controller of a company, while the real decision-maker hides behind them. And when ultra-wealthy individuals attempt to exploit the system, the deception becomes far more layered, protected, and emotionally unsettling. A nominee director is meant to serve as a formality, someone listed on paper to represent a company in a legal or administrative sense, but when misused, that person becomes a mask, a stand-in, a shield blocking the world from seeing who is truly giving the orders. The company appears legitimate, the paperwork looks proper, and yet the real power operates quietly from the shadows. Ultra-wealthy individuals often sit behind vast networks of companies, trusts, and financial structures. In environments where complexity is normal, slipping a nominee director into the chain of control can be almost invisible. Their name takes the spotlight, while the true controller steps into the background, hidden from liability, scrutiny, or accountability. To regulators and outsiders, the company's leadership seems clear, but in reality, major decisions, financial movements, and strategic choices come from someone who never appears on a single public document. That split between appearance and truth is where the emotional weight lies, the unsettling realization that the person in charge may not be in charge at all. What makes this misuse particularly disturbing is the way it manipulates trust. People assume that the names on official records represent real authority. They assume responsibility follows visibility. But nominee misuse breaks that connection entirely. It allows powerful individuals to influence companies without being tied to them, shaping actions while avoiding the consequences that would normally follow. When ultra-wealthy individuals misuse nominee directors, it becomes more than a corporate tactic. It becomes a way to rewrite identity itself, separating control from accountability and creating a polished public facade that hides the true source of power operating just out of sight. False invoicing for services. False invoicing for services is the act of creating invoices for work that was never performed or drastically misrepresented. And when ultra-wealthy individuals attempt to use it, the scheme becomes far more intricate, convincing, and emotionally unsettling. At its core, false invoicing turns paperwork into a disguise. Documents that appear legitimate on the surface but exist solely to move money into places it shouldn't go. It is a manipulation built on the assumption that official-looking records will be believed without question. Ultra-wealthy individuals who attempt this tactic don't rely on amateur paperwork or sloppy fabrications. They build entire structures around the illusion, consulting firms that never consult, advisory contracts that provide no advice, and service agreements full of elegant language but empty of real work. These invoices are crafted to appear professional, supported by polished branding, legal wording, and signatures that imply credibility. To an outside observer, the documents look no different from those used by global corporations every day. What makes false invoicing emotionally powerful is how deceptively normal the process feels. A transaction is recorded, a business claims an expense, a payment is justified. Nothing looks out of place. Yet each invoice is a tool of misdirection, a piece of fiction designed to shift funds without triggering suspicion. Ultra-wealthy individuals can run these false charges through multiple companies, blending them into their financial operations until the truth dissolves into the complexity. The psychological tension comes from the ease with which the illusion holds. Ordinary people pay real money for real services, but someone with vast resources can fabricate entire streams of activity that exist only on paper. False invoicing for services becomes a financial mirage. Crisp documents masking movements that were never meant to be seen, reshaping reality with nothing more than ink, signatures, and strategically crafted lies. Asset misappropriation. Asset misappropriation is the act of taking or using assets that don't belong to you for personal benefit. And when ultra-wealthy individuals attempt to use it, the manipulation becomes more subtle, more sophisticated, and emotionally unsettling. At its core, misappropriation is simple. Someone diverts assets, money, property, inventory, investments into their own hands under the veil of legitimacy. But the ultra-wealthy rarely do it in obvious ways. Instead of physically taking something, they manipulate the systems meant to guard it, bending controls, approvals, or authority to quietly redirect value toward themselves. For the ultra-wealthy, the danger lies in how effortlessly their influence can mask wrongdoing. They may sit at the top of companies, foundations, or investment groups, giving them the ability to approve transfers, reassign ownership, or reallocate funds under the guise of business necessity. From the outside, these movements look routine: executive decisions, internal adjustments, corporate strategies. The emotional impact comes from realizing how easily someone in a position of power can turn professional authority into a tool for personal gain, all while maintaining the appearance of legitimacy. The unsettling truth is that asset misappropriation often hides inside trust. Employees trust their leaders, investors trust executives, communities trust wealthy figures running charities or businesses. That trust creates space for individuals with immense resources to move assets subtly without immediate suspicion. What looks like a business expense may actually be a private benefit. What appears to be a strategic investment might quietly enrich the person controlling the transaction. What makes asset misappropriation so emotionally charged when used by the ultra-wealthy is the scale of the impact. Ordinary misappropriation harms a company or a small group, but when someone with vast power redirects assets for their benefit, the ripple effect can drain entire organizations, destroy investments, and destabilize communities, all while the public sees a polished figure who seems to be acting within their authority, never realizing the truth hidden beneath the surface. Corporate identity fraud. Corporate identity fraud is the act of stealing, imitating, or manipulating a company's legal identity to gain access to money, contracts, or resources. And when ultra-wealthy individuals attempt to weaponize this tactic, the deception becomes far more sophisticated and emotionally disturbing. At its core, corporate identity fraud is about slipping into the skin of a legitimate business, using its name, reputation, or legal documents to open accounts, authorize transactions, or shape deals that should never have been approved. The fraud works because people trust companies that appear established and credible. When someone with immense wealth chooses to misuse this method, they don't forge sloppy documents or impersonate small organizations. They target powerful entities with reputations that shield suspicion. They may exploit dormant companies, acquire distressed corporations with intact identities, or use highly convincing replicas of branding and documentation. With enough resources, the imitation looks flawless. Banks, partners, and investors often don't question what appears legitimate on the surface, and that surface-level trust becomes the disguise that hides everything underneath. The unsettling emotional weight comes from how convincingly this fraud can distort reality. A contract might be signed with a company that doesn't truly exist. Payments may be sent to accounts controlled by someone entirely disconnected from the business being used as cover. People believe they're working with an established corporate name, unaware that they're interacting with a shell crafted for manipulation. Meanwhile, the ultra-wealthy orchestrator remains insulated behind layers of actors, legal buffers, and corporate structures that blur their involvement. What makes corporate identity fraud so haunting is how easily trust can be reconstructed. A polished logo, a registered address, a professional email domain, everything looks real. And when someone with vast resources exploits that illusion, they can make entire organizations believe they're dealing with legitimacy, even as they unknowingly step into a trap built from fabricated identity and stolen credibility. Bank loan fraud. Bank loan fraud is the act of obtaining financing through false information, hidden intentions, or manipulated documents. And when ultra-wealthy individuals attempt to use it, the deception becomes more polished, more strategic, and emotionally unsettling. At its core, this fraud relies on one dangerous advantage: credibility. Banks trust people with wealth. They trust strong credit histories, impressive portfolios, and powerful reputations. That trust becomes the perfect doorway for manipulation when someone uses it to secure loans they should never qualify for, or for purposes they never disclose. Ultra-wealthy individuals often control corporations, real estate networks, and investment structures that can make any financial request look legitimate. When they attempt bank loan fraud, they don't forge a single document or invent a simple lie. They manipulate the entire narrative around their financial status. A company can appear stronger than it truly is. Collateral can be inflated beyond reality. Cash flow can be overstated, and liabilities can be hidden behind layers of entities designed to look independent. To an outside observer, the loan file looks clean, professional, and trustworthy. The illusion is carefully built to hide the cracks. The emotional impact comes from the imbalance of trust. Ordinary people are scrutinized intensely for even small loans, forced to prove every detail of their finances. But ultra-wealthy individuals can bypass suspicion simply because of the image they project. Their status becomes armor. Their influence becomes a disguise. When that trust is exploited, the damage doesn't just affect a bank. It spreads into the system that relies on honesty to function. What makes bank loan fraud particularly disturbing at high levels of wealth is how invisible it can be. Numbers appear solid. Documents seem authentic. The fraud is buried beneath confidence and prestige, turning the financial system into a stage where power shapes perception and truth becomes whatever the paperwork claims it is. Mortgage fraud. Mortgage fraud is the act of lying on loan applications or manipulating property details to secure financing that wouldn't be approved honestly. And when ultra-wealthy individuals attempt to use it, the scheme becomes far more subtle, coordinated, and emotionally disturbing. At its core, mortgage fraud twists a simple truth about real estate. Lenders trust paperwork. Banks rely on reported income, property values, and borrower information to decide how much money to lend, and this dependence on documented facts becomes the perfect place to hide intentional deception. Ultra-wealthy individuals who attempt mortgage fraud rarely falsify a single form or inflate a modest income. Instead, they weave the manipulation into complex networks of companies, appraisers, and intermediaries that make the fraud look indistinguishable from legitimate business properties, maybe intentionally overvalued by compliant professionals. Ownership structures can be arranged to hide risks, and financial statements may be crafted to present a perfectly engineered image of stability. On the surface, everything appears flawless: luxury properties, high credit scores, polished financial profiles, but beneath that shine lies a deliberate distortion. What makes mortgage fraud emotionally powerful is how sharply it contrasts with the experience of ordinary people. Most borrowers struggle through endless paperwork, strict verification, and rigid scrutiny just to secure a modest loan. Meanwhile, someone with enormous wealth who attempts to manipulate the system can glide through the process with confidence, protected by influence, appearance, and connections. It creates a haunting imbalance, the idea that rules feel rigid for some and malleable for others. The psychological sting deepens when you realize how convincing these fabrications can be. A property that appears to be a smart investment may be built on inflated numbers. A glamorous real estate portfolio may be supported by financial statements designed to impress rather than reflect truth. Mortgage fraud in the hands of the ultra-wealthy becomes a quiet rewriting of reality, turning paperwork into a tool for bending the financial world to their advantage, while the truth hides behind polished signatures and engineered credibility. Insurance fraud is the act of deceiving an insurance company for financial gain, and when ultra-wealthy individuals attempt to use it, the manipulation becomes far more intricate, protected, and emotionally unsettling. At its core, insurance fraud is about creating a false narrative, pretending a loss occurred, exaggerating damage, or engineering situations that trigger payouts. But the ultra-wealthy rarely engage in obvious scams. Instead of faking a small injury or inflating a minor claim, they weave complex stories around high-value assets, luxury properties, rare collections, or business operations where the truth can vanish behind polished paperwork and expert-sounding reports. For the ultra-wealthy, the disguise often lies in scale: a multi-million-dollar yacht damaged beyond repair, a mansion struck by a conveniently timed disaster, or a priceless piece of art reported lost can all generate enormous payouts. Because the assets themselves are extraordinary, the claims appear believable. What seems suspicious for an average person looks perfectly normal for someone who lives surrounded by luxury. The emotional impact comes from realizing how easy it is for wealth to blur the line between legitimate loss and carefully crafted fiction. The unsettling truth is that insurance companies often treat the wealthy with a different level of trust. Their status, connections, and influence create a shield of credibility. When they file claims, investigators may hesitate to push too hard. Experts may accept explanations at face value, and the sheer complexity of the assets makes uncovering deception far more difficult. Behind that shield, a fraudulent claim can move smoothly through the system, untouched by the scrutiny ordinary people face. What makes insurance fraud so emotionally charged in the hands of the ultra-wealthy is the distortion of fairness. While everyday people struggle to prove even honest claims, someone with vast resources can manipulate documentation, narrative, and perception to turn false losses into real money, quietly shifting financial burdens while maintaining the appearance of innocence. Credit card fraud. Credit card fraud is the act of using someone else's card information to make unauthorized purchases or withdrawals. And when ultra-wealthy individuals attempt to involve themselves in this kind of scheme, the manipulation shifts from petty theft to large-scale exploitation that hides behind sophistication and influence. At its core, credit card fraud seems like a simple crime: steal the numbers, use the card, disappear. But when someone with immense resources chooses to misuse this tactic, they do not rely on basic theft or random targets. They exploit systems, loopholes, and positions of power in ways that feel disturbingly invisible. Ultra-wealthy individuals who attempt credit card fraud don't swipe stolen cards at gas stations or test small transactions online. Instead, the fraud may occur through corporate cards, subsidiary accounts, or financial privileges that allow them to access funds without immediate scrutiny. They can hide unauthorized spending behind business expenses, travel budgets, or corporate reimbursements, transactions that look normal to auditors because wealth creates the illusion of legitimacy. A charge that would raise questions for an ordinary person blends effortlessly into the lifestyle of someone who spends freely and regularly. The emotional tension comes from the imbalance this reveals. Everyday people fear a single fraudulent charge, knowing banks will question them immediately, but someone with enormous wealth can attempt to bury fraudulent activity under layers of accounting, assistance, corporate departments, and financial flows. The misuse becomes harder to detect because it fits their public image: high spending, constant movement, endless transactions. It becomes a form of camouflage, money disappearing in plain sight. What makes credit card fraud particularly haunting at the ultra-wealthy level is how normalized it can look. A luxury purchase, an international hotel stay, or a suspicious transfer doesn't stand out when it belongs to someone whose lifestyle already matches those patterns. And behind that normality, unauthorized charges can hide like whispers in a storm, unnoticed by all but the one who initiated them. Synthetic identity finance. Synthetic identity finance involves creating a false, blended identity, part real, part fabricated, to open financial accounts or gain access to credit. And when ultra-wealthy individuals attempt to exploit this tactic, the deception becomes disturbingly sophisticated and emotionally unsettling. At its core, a synthetic identity is a ghost built from fragments of truth, a real social security number that doesn't match a name, a fabricated address paired with authentic-looking documents, or digital credentials stitched together to form a person who doesn't exist. This manufactured identity becomes a mask that can move through the financial system unnoticed because it appears just real enough to pass automated checks, yet fake enough to detach the true actor from liability. Ultra-wealthy individuals have the resources to elevate this deception far beyond simple forgery. Their legal teams, corporate structures, and technological access give them room to hide inside complexity. A synthetic identity can be tied to shell companies, digital wallets, or accounts created through networks so elaborate that even trained analysts struggle to separate truth from invention. To the outside world, the identity seems legitimate. Credit scores rise, accounts function normally, and financial activity blends seamlessly into the noise of millions of daily transactions. Meanwhile, the real person pulling the strings remains invisible, shielded behind a character they've constructed. The emotional intensity comes from how deeply this tactic manipulates trust. Financial institutions rely on identity as the foundation of security. Every loan, account, and transaction depends on believing that the person on the application is real and accountable. Synthetic identity finance breaks that belief at its core. It turns identity, a fundamental aspect of human existence, into a tool of deception. When ultra-wealthy individuals engage in synthetic identity schemes, the act becomes more than forging documents or fabricating data. It becomes a method of slipping past the boundaries that protect society, allowing power to hide behind a face that never truly existed, while the real architect moves untouched behind the scenes. Counterfeit goods revenue flow. Counterfeit goods revenue flow is the movement of money generated from selling fake products, luxury bags, electronics, pharmaceuticals, clothing, and when ultra-wealthy individuals attempt to exploit it, the operation becomes far more expansive, disguised, and emotionally unsettling. At its core, this scheme is about turning imitation into profit while hiding the financial trail behind layers of legitimacy. It transforms knockoff goods into a silent revenue machine, one that thrives on the public's inability to distinguish what is real from what is deceptively close. Ultra-wealthy individuals who attempt to benefit from counterfeit revenue rarely handle the goods themselves. Instead, they position themselves behind distributors, factories, importers, or shell companies that appear completely unrelated to the counterfeit operation. The profits then move through these channels as if they came from normal sales, blending illicit earnings with legitimate business revenue. A fake designer watch looks convincing enough in a store window. The financial path behind it can look just as convincing on a balance sheet. The closer the imitation is to the real thing, the easier the deception becomes. What makes counterfeit revenue flow so emotionally charged is how quietly it infiltrates everyday life. A customer buys what they believe is a premium product, unaware that their money is feeding a hidden network. A brand's reputation weakens without knowing why. Meanwhile, someone with immense wealth may be profiting from this silent erosion, protected by layers of corporate distance that make the truth nearly unreachable. The scheme turns imitation into influence, letting financial gain hide behind the world's trust in appearances. The psychological impact deepens when you realize how easily counterfeit money slips into the global economy. A transaction looks normal, a business looks successful, a profit margin looks impressive, yet the foundation is built on deception. In the hands of the ultra-wealthy, counterfeit goods revenue flow becomes a shadow system of profit, quietly reshaping markets while the truth stays buried behind the illusion of authenticity. Counterfeit currency distribution. Counterfeit currency distribution is the act of injecting fake money into the financial system, and when ultra-wealthy individuals attempt to use it, the deception becomes far more controlled, insulated, and emotionally disturbing. At its core, counterfeiting isn't just about printing fake bills, it's about creating a false sense of value, a lie that spreads silently through the hands of unsuspecting people. But when someone with immense wealth becomes involved, the operation doesn't look like back-alley printing presses or crude replicas. It hides behind layers of influence, global networks, and transactions so large that a counterfeit note becomes just one thread in a much bigger fabric of manipulation. For the ultra-wealthy, the power lies in distribution. They don't personally pass bills at gas stations or stores. Instead, they may attempt to move counterfeit value through businesses, intermediaries, or high-volume cash environments where the flow is too fast to examine carefully. Luxury markets, international trade, and complex enterprises can become quiet channels where fake currency blends seamlessly with legitimate funds. The emotional impact comes from realizing how invisible this process can be, how easily false money can circulate once it enters systems that were never designed to question the hands of the powerful. What makes this especially unsettling is how counterfeit currency destabilizes trust long before it's discovered. People rely on money as a symbol of stability, something that holds value simply because everyone believes in it. When a wealthy individual uses their status to push fake currency into circulation, it is not just an economic violation, it's a psychological one. It shakes the foundation of everyday transactions, turning something as simple as a banknote into a hidden threat. The emotional weight grows when you understand the imbalance. Ordinary people face intense scrutiny for every dollar they deposit, while someone with immense wealth may manipulate entire financial ecosystems without ever appearing connected. Counterfeit currency distribution, when tied to the ultra-wealthy, becomes not just fraud, it becomes a quiet distortion of reality, a way to rewrite value while the world continues trading, unaware that something in their hands was never real. Art market laundering. Art market laundering is the practice of using high-value artworks to hide, move, or disguise money. And when ultra-wealthy individuals attempt to exploit this system, the manipulation becomes almost theatrical in its elegance and emotional impact. At its core, the art world is built on subjectivity. Value is fluid, prices are negotiable, and ownership can shift through private deals that leave barely a trace. That ambiguity becomes a shield. Art doesn't behave like ordinary assets. It speaks in whispers, not numbers, and the ultra-wealthy know how to turn that whisper into a mask. When someone with immense resources chooses to misuse the art market, they take advantage of its greatest vulnerability: secrecy. Many transactions happen privately, away from public auctions, handled through galleries, dealers, or intermediaries who rarely disclose the true buyer or seller. A painting can change hands for millions without anyone outside the room knowing who actually owns it. Ultra-wealthy figures might attempt to move money by inflating or deflating the supposed value of a piece, buying from themselves through intermediaries, or shifting artworks across borders where cultural and financial oversight is weak. The artwork becomes a vessel, a silent container that carries money disguised as beauty. The emotional sting lies in the contrast between what art represents and what it can be used for. People see art as culture, expression, and creativity. They don't imagine it functioning as a secret financial pipeline. Yet, a single canvas stored in a climate-controlled vault can quietly hold millions in hidden value, moving wealth through galleries and free ports without drawing suspicion. Everyday people must document every transaction, every deposit, every shift in funds, while the ultra-wealthy can hide fortunes behind brushstrokes and signatures that no algorithm can interpret. What makes art market laundering feel so haunting is how easily beauty becomes camouflage. A masterpiece can be admired, displayed, hidden, or traded, all while concealing movements of money that no one is meant to see. Antiquities trafficking finance. Antiquities trafficking finance is the use of ancient artifacts, stolen, smuggled, or illegally excavated, to move, hide, or legitimize money. And when ultra-wealthy individuals attempt to exploit this system, the manipulation becomes far more chilling and emotionally charged. At its core, antiquities trafficking relies on one unsettling truth: history has no voice. A priceless statue, a centuries-old tablet, a sacred relic stolen from a conflict zone cannot report where it came from or who took it. That silence becomes the perfect vessel for wealth to flow through the shadows, disguised as culture, heritage, and art. Ultra-wealthy individuals often move in circles where rare artifacts are status symbols. Museums, private galleries, exclusive auctions. These environments give illicit antiquities a path into legitimacy. When someone with immense resources attempts to use antiquities trafficking finance, they can acquire artifacts with questionable origins, move them across borders under vague descriptions like decorative object, and then resell or donate them as if they were unquestionably authentic and legally obtained. One transaction can transform stolen history into a perfectly clean asset on paper. The artifact becomes both a trophy and a financial instrument, its past erased by the prestige of its new owner. The emotional impact strikes deeper than most financial schemes because antiquities trafficking isn't just about money. It's about erasing culture. Objects ripped from ancient temples, graves, and heritage sites are converted into tools for concealment. Entire communities lose irreplaceable pieces of their identity, while someone at the top quietly gains a powerful method of moving wealth under the guise of appreciation for art. When ultra-wealthy individuals engage in antiquities trafficking finance, the deception becomes more than a financial strategy. It becomes a haunting merger of power, privilege, and cultural theft. The world sees beauty displayed in luxurious homes, but beneath that display lies a story of stolen history, hidden money, and identities erased so wealth can travel unseen. Illegal gambling finance. Illegal gambling finance is the movement of money generated through unregulated underground betting operations, and when ultra-wealthy individuals attempt to exploit it, the machinery becomes far more organized, insulated, and emotionally unsettling. At its core, illegal gambling finance relies on a simple human weakness, the desire for risk, excitement, and fast returns. But behind the flashing lights and whispered bets lies a financial engine that operates completely outside the boundaries of transparency, allowing vast sums of untracked cash to flow through hidden channels. Ultra-wealthy individuals who attempt to tap into this world rarely stand anywhere near the tables or the backroom operations. Instead, they position themselves in the shadows behind intermediaries, entertainment fronts, private clubs, or offshore networks that appear unrelated to the gambling itself. The money generated, pools of cash from bets, games, and high-stakes wagers, is quietly funneled through these channels, appearing to originate from legitimate business activity. From the outside, it looks like success born from hospitality, nightlife, or entertainment. In reality, it's a silent river of unregulated income moving beneath the surface. What makes illegal gambling finance so emotionally charged is how invisible it feels to everyone else. A city may see bustling venues, glamorous parties, or exclusive gatherings, unaware that some are built on money that never touches legal oversight. Families may lose savings chasing luck, not knowing that the system they're feeding is designed to remain untraceable. Meanwhile, someone with immense wealth may be reaping the rewards from a distance, shielded by layers of ownership and influence that make accountability feel almost impossible. The psychological sting deepens when you realize how easily these hidden profits blend into the legitimate world. A thriving business, a rising empire, a luxurious lifestyle, all can be quietly powered by money born from desperation and risk. Illegal gambling finance, in the hands of the ultra-wealthy, becomes a shadow economy, one that thrives on secrecy, feeds on human vulnerability, and hides behind the glitter of entertainment while the truth moves through the darkness, unseen. Sports betting fraud. Sports betting fraud is the manipulation of athletic outcomes or wagering systems for financial gain, and when ultra-wealthy individuals attempt to use it, the corruption becomes deeper, more coordinated, and emotionally jarring. At its core, this form of fraud revolves around controlling what should be unpredictable. Sports are built on fairness, chance, and genuine competition, qualities people trust. But when someone with immense wealth steps in to influence results, the entire foundation cracks. Games stop being games, wins stop being earned, outcomes become scripted moments designed to feed a hidden profit machine. For the ultra-wealthy, the power lies not in placing a simple bet, but in manipulating the environment around it. They may cultivate relationships with insiders, leverage influence over teams or organizations, or use intermediaries to place wagers across multiple jurisdictions, disguising patterns that would expose an ordinary fraudster instantly. Their status gives them access to athletes, managers, or officials who may feel pressured or tempted, turning the integrity of the sport into a commodity, quietly traded behind closed doors. The emotional impact comes from realizing how easily passion, loyalty, and competition can be twisted by someone who sees the game not as a sport, but as an opportunity. What makes sports betting fraud especially unsettling in the hands of the ultra-wealthy is how invisibly it operates. Fans celebrate victories, mourn losses, and argue over rivalries without knowing the truth was predetermined. Billions of viewers experience manipulated emotions, while a select few profit from outcomes they engineered. The stadium roars, the cameras roll, and the world believes in the authenticity of the moment. Yet, beneath the surface, the fairness people expect has been quietly eroded. Sports are supposed to be one of the last places where effort decides everything. When ultra-wealthy individuals turn that purity into a personal profit system, the betrayal cuts deeper, replacing genuine competition with a manufactured reality most people never realize they're watching. Match-fixing finance. Match-fixing finance is the manipulation of sports outcomes for financial gain. And when ultra-wealthy individuals attempt to entangle themselves in this world, the corruption grows quieter, more coordinated, and far more emotionally jarring. At its core, match-fixing twists something meant to be pure competition into a controlled performance staged for profit. The emotional gravity comes from how deeply people trust sports. Fans believe in fairness, in effort, in skill. But when someone with immense wealth decides to interfere, the game stops being a game and becomes a financial tool disguised as entertainment. Ultra-wealthy figures who attempt to exploit match-fixing don't bribe small-time players in back rooms or deal in obvious exchanges. They operate from a distance, using intermediaries, shadow networks, or betting syndicates to influence outcomes without ever touching the field. They may target referees, team insiders, or athletes vulnerable to pressure, creating subtle shifts, a missed call, a poorly timed substitution, a deliberate mistake that appears accidental. To the public, it looks like normal sports unpredictability. To the orchestrator, it's the result of coordinated influence designed to guarantee financial return. The emotional weight intensifies when you consider what this manipulation destroys. Sports carry national pride, personal identity, and cultural meaning. People spend years supporting teams, believing in underdogs, celebrating victories that feel earned. Yet, a wealthy manipulator can quietly rewrite the outcome, turning honest effort into a scripted illusion for personal profit. The victims aren't just bettors or leagues, it's every fan who trusted what they were watching. What makes match-fixing finance so disturbing is how invisible it can be. Games unfold, crowds cheer, players compete, and no one sees the invisible hands shaping the result. And when the ultra-wealthy use their resources to corrupt something so deeply tied to human passion, the truth becomes a silent betrayal hidden beneath the roar of the stadium. Illicit political donations. Illicit political donations involve secretly channeling money to influence elections, policies, or public officials outside the boundaries of the law. And when ultra-wealthy individuals attempt to use this tactic, the manipulation becomes deeper, more strategic, and emotionally unsettling. At its core, illicit donations are about bending the political system with money that was never meant to be seen. Its influence disguised as generosity, power hidden inside envelopes, shell companies, intermediaries, or independent groups that act as shadows rather than supporters. On paper, democracy looks fair. Beneath the surface, money quietly pushes the scales. Ultra-wealthy individuals often sit close to the machinery of politics, fundraisers, lobbyists, consultants, and private networks where access is bought long before the public ever votes. When they attempt illicit political donations, the money rarely moves directly. It's routed through entities that look legitimate, funneled through foundations, disguised as consulting fees, or broken into smaller contributions passed through third parties. Each layer adds distance between the donor and the influence they're buying, creating the illusion of compliance while quietly reshaping outcomes behind the scenes. The public sees a campaign gaining momentum. They never see the hidden hand fueling it. The emotional weight comes from how deeply this tactic attacks trust. People believe their vote carries power, that leaders rise because of ideals, not secret funding streams. Illicit donations shatter that belief. They turn elections into marketplaces where influence is auctioned off to those who can afford it, while ordinary citizens unknowingly live under decisions shaped by money they never saw and forces they never voted for. When ultra-wealthy individuals engage in illicit political donations, it becomes more than bending rules. It becomes rewriting the direction of society From the shadows, policies shift, leaders change, and entire nations feel the effects of decisions steered not by the will of the people, but by the hidden flow of money that was never supposed to be there. Campaign finance violations. Campaign finance violations involve secretly influencing elections through money that is hidden, misreported, or pushed into political systems in ways the law does not allow. And when ultra-wealthy individuals attempt to use this tactic, the manipulation becomes far more calculated, concealed, and emotionally unsettling. At its core, these violations are about bending democracy, tilting the playing field not by winning public support, but by quietly injecting resources where they shouldn't go. It's a distortion of the political process disguised as civic participation. Ultra-wealthy individuals who attempt to engage in this behavior don't typically hand over envelopes of cash. They use influence masked as generosity funds may be routed through companies, nonprofits, associates, or political action groups that appear fully legitimate on the surface. Donations can be broken into smaller pieces, redirected through intermediaries, or labeled under categories that hide their true origin. The powerful individual stays several layers removed from the transaction, presenting the image of a disconnected supporter while quietly pushing the political outcome in a direction that benefits them. What makes campaign finance violations emotionally powerful is the invisible way they change the world ordinary people live in. A policy shifts, an election tightens, a candidate suddenly gains momentum they shouldn't have. To the public, it looks like democracy in motion, but beneath the surface, someone with immense wealth may be quietly steering the future from behind a curtain of influence and anonymity. The manipulation doesn't happen through speeches or debates. It happens through financial pressure that voters never see. The psychological tension grows when you realize how perfectly respectable these actions can appear. Lavish events, charitable donations, advocacy groups, political committees, all can serve as elegant masks for money meant to shape power. In the shadows, campaign finance violations in the hands of the ultra-wealthy become a silent rewriting of the democratic process, where influence hides inside polished checks and strategic contributions, shifting the direction of society before anyone realizes the truth. Foundation misuse. Foundation misuse occurs when someone uses a charitable foundation, an organization meant to help others, as a personal financial shield, and when ultra-wealthy individuals attempt to use it, the deception becomes more polished, more strategic, and emotionally disturbing. A foundation is supposed to represent generosity, compassion, and social responsibility, but in the hands of someone seeking personal gain, it becomes a mask, a pristine, respected facade that hides the quiet redirection of money and influence behind the scenes. Ultra-wealthy individuals often build foundations that look flawless on the surface: glossy websites, inspiring missions, impressive donations. But misuse happens when the foundation stops being about the cause and starts becoming a tool. They may funnel money toward projects that secretly benefit their businesses, inflate the value of donations, route funds to associates under the disguise of grants, or use the organization to improve their public image while giving far less than the world believes. The emotional sting comes from realizing how easily kindness can be counterfeited, how a symbol of hope can be twisted into a shield for self-interest. What makes foundation misuse especially unsettling is the trust it exploits. Foundations gain automatic respect. Donors, communities, and governments see them as benevolent forces. When an ultra-wealthy figure misuses that trust, they manipulate people's belief in goodness itself. The public sees charity galas, heartfelt speeches, and press releases celebrating philanthropy, while behind the scenes money flows in directions that serve personal agendas instead of public needs. The emotional weight deepens when you understand the impact. Real charities struggle for funding while a misused foundation absorbs praise without delivering genuine help. Communities wait for promised support that never arrives, and the individual behind it all maintains a spotless reputation, celebrated as a humanitarian while privately benefiting from the very system meant to uplift others. Foundation misuse in the hands of the ultra-wealthy becomes a distortion of compassion, turning charity into camouflage and replacing true generosity with a carefully curated illusion. Charity misuse. Charity misuse is the act of taking an organization built on compassion, generosity, and public trust and twisting it into a hidden channel for personal gain. And when ultra-wealthy individuals attempt to exploit the system, the betrayal becomes deeper, quieter, and emotionally devastating. At its core, charity misuse manipulates the belief that charitable organizations exist to help people. Donations are supposed to feed families, fund medical research, support education, and strengthen communities. But in the hands of someone with immense resources, a charity can become a mask, an entity that looks noble on the outside while its inner workings serve a completely different agenda. Ultra-wealthy figures who attempt to misuse charities don't do it through obvious theft or sloppy accounting. Instead, they use influence, reputation, and complex financial structures to redirect funds, hide assets, or gain advantages under the guise of philanthropy. Money can be routed through foundations that appear generous, but primarily benefit the donor. Family members can be placed in high-paying administrative roles. Donations can be used to buy social status, political leverage, or access to elite circles. What the public sees is kindness. What's happening behind the scenes is strategic manipulation disguised as goodwill. The emotional impact hits hardest when you realize what's truly being exploited. Trust. People give to charities because they want to believe in the goodness of others. When someone with immense wealth uses that trust as cover for hidden motives, it corrupts more than money. It corrupts hope. Communities that depend on these funds are left under-resourced, while the orchestrator enjoys the glow of public praise. What makes charity misuse so haunting is the contrast between image and intent. A smiling photo, a ribbon-cutting ceremony, a generous public announcement, all can conceal a system quietly serving the interests of one person while pretending to serve everyone else. Donor-advised fund misuse. Donor-advised fund misuse occurs when individuals exploit charitable accounts meant for public good to quietly move, hide, or redirect wealth. And when ultra-wealthy individuals attempt to misuse these funds, the manipulation becomes far more subtle, more reputationally protected, and deeply unsettling. At its core, a donor-advised fund, often called a DAF, is supposed to be a charitable vehicle where donors contribute money, receive an immediate tax deduction, and then recommend how the fund should be distributed over time. It is meant to support generosity, not concealment. But when someone with immense wealth chooses to twist this system, the same structure that encourages giving becomes a shield that hides what they don't want seen. Ultra-wealthy figures who misuse DAFs rely on the fact that once money enters the fund, it no longer legally belongs to them, yet they continue influencing where it goes. This creates a perfect illusion, the appearance of philanthropy paired with quiet control. They can move large sums into a DAF, gain significant tax benefits, and then allow the funds to sit untouched for years, earning public praise for giving, even though no meaningful charity occurs. In more insidious cases, they may steer the money toward organizations they already influence, entities tied to their interests, or groups that indirectly benefit their businesses, reputation, or agenda. On paper, everything looks generous. In reality, the funds function more like a disguised financial tool than a charitable act. The emotional tension lies in the betrayal of trust. People assume charitable giving reflects integrity, compassion, and genuine support for others. But DAF misuse turns generosity into a mask, one that hides intentions. safeguards wealth, and manipulates public perception. What makes this so disturbing is how morally clean it appears. Tax benefits, public praise, philanthropic status, all of it can be maintained while the true purpose of the money remains hidden behind a facade of good intentions. Misuse of grant money. Misuse of grant money is the intentional diversion of funds meant to support public programs, research, or community projects, and when ultra-wealthy individuals attempt to exploit this system, the corruption becomes disturbingly subtle, deeply strategic, and emotionally charged. At its core, grant funding is built on trust, money awarded to create change, solve problems, or uplift communities. But when someone with immense resources chooses to manipulate this process, that trust becomes the gateway through which money is quietly redirected into purposes never approved, never disclosed, and never meant to benefit anyone except the orchestrator. Ultra-wealthy figures who attempt to misuse grants rarely do it through blatant, sloppy actions. Instead, they influence the process from within corporate foundations, research institutions, or organizations they control. They can reroute funds into side projects, inflate administrative costs, or create consulting roles that funnel money into their own networks. On paper, every dollar appears justified, reports look polished, invoices look legitimate, and progress updates feel convincing. The scheme hides behind professionalism, making the misuse look like ordinary operations rather than a betrayal of the mission the grant was meant to support. The emotional impact is powerful because grant money is supposed to help people who need it most. It's meant to lift communities, fuel innovation, advance science, or provide resources to those with limited means. When ultra-wealthy individuals twist this system for personal advantage, the loss hits far beyond financial terms. A school doesn't receive its materials, a medical study goes underfunded, a community project collapses before it begins. The consequences ripple outward, harming people who were promised opportunity. What makes this form of misuse especially disturbing is the illusion of generosity surrounding it. Wealthy figures may appear charitable on the surface, while quietly siphoning the very funds meant to create real change. State capture financing. State capture financing is the manipulation of government power through strategic financial influence, and when ultra-wealthy individuals attempt to use it, the corruption becomes deeper, slower, and far more emotionally unsettling than most people realize. At its core, state capture is not about bribing a single official. It is about quietly reshaping the machinery of a nation so that laws, policies, and decisions tilt toward the interests of a select few. What makes this especially disturbing is how invisible it often appears. To the public, everything looks like normal politics. Behind the scenes, financial power is rewriting the rules that everyone else must follow. Ultra-wealthy individuals who attempt to engage in state capture financing rarely operate openly. They build influence through donations, lobbying networks, strategic investments, or partnerships with key political figures. They may target regulators, legislators, or agencies that shape markets and national policies. Each connection seems harmless on its own, but together they form a quiet web of influence capable of steering entire sectors of a country's economy. A regulation delayed, a penalty softened, a decision redirected, all of it can be orchestrated without ever revealing the hand behind the shift. The emotional impact of state capture is profound because it distorts the foundation of fairness people expect from their leaders. Citizens vote believing their voices matter, yet someone with extraordinary wealth can bend decisions long before they reach the public eye. Public resources may be diverted, opportunities narrowed, and institutions weaken, while the ultra-wealthy orchestrator benefits from a system subtly redesigned around their interests. What makes state capture financing so haunting is its silence. Nothing explodes, nothing collapses overnight. Instead, a nation slowly changes shape, under the weight of influence few will ever see, leaving ordinary people living in a system quietly molded by someone they never elected. Procurement cartel finance. Procurement cartel finance is the coordinated manipulation of bidding processes by groups that secretly work together to control who wins major contracts. And when ultra-wealthy individuals attempt to involve themselves in these schemes, the corruption becomes colder, more strategic, and emotionally unsettling. At its core, a procurement cartel destroys the idea of fair competition. Instead of companies battling honestly for a contract, a hidden alliance decides the outcome long before the bids are even submitted. Everything becomes a performance, fake competition, masking predetermined victory. And when immense wealth steps into this shadowed structure, the manipulation expands beyond simple collusion and evolves into a system of power shaping entire industries. Ultra-wealthy individuals who attempt to exploit procurement cartels do not operate openly. They use influence, subsidiaries, shell entities, and quiet partnerships to ensure that every competitor in the bidding process is secretly connected to them or aligned with their interests. The bids appear different on paper, but behind the scenes, they move as one unit, like different faces of the same hidden empire. Prices are inflated, quality is sacrificed, and the winning contract is never actually competitive. It's already been assigned. The public sees paperwork, formal announcements, and official ceremonies. What they don't see is the prearranged agreement that determined everything before the process even began. The emotional weight of procurement cartel finance comes from its ripple effect. These contracts often involve public infrastructure, hospitals, transportation, utilities, systems people depend on every day. When a cartel controls these decisions, communities pay more and receive less, all while someone with immense wealth profits from the illusion of legitimacy. The haunting part is the invisibility. Everything looks official, fair, and regulated, while a hidden network quietly dictates outcomes to benefit the few at the expense of the many. Bid rigging schemes. Bid rigging schemes occur when competing parties secretly coordinate the outcome of a bidding process, turning what should be fair competition into a controlled performance designed to guarantee a predetermined winner. When ultra-wealthy individuals attempt to involve themselves in this kind of manipulation, the entire system becomes more polished, more hidden, and emotionally disturbing in its reach. At its core, bid rigging destroys the trust that public institutions, corporations, and communities place in open competition. It transforms something meant to protect fairness into a silent conspiracy that funnels money upward. Ultra-wealthy orchestrators don't operate like small-time fraudsters. They build networks, executives, suppliers, partners, subsidiaries who appear independent on paper, but answer to the same quiet influence. These individuals or companies submit bids that look legitimate, but the outcome has already been agreed upon behind closed doors. Sometimes they rotate winners, sometimes they submit intentionally inflated bids, and sometimes they withdraw at strategic moments to make the chosen party seem naturally competitive. To observers, everything appears professional and procedural. To the manipulator, it is choreography. The emotional impact lies in what this corruption steals. Contracts meant for the best performers, lowest prices, or most innovative companies instead fall into the hands of those who already hold power. Public funds meant to build roads, schools, hospitals, or infrastructure are quietly siphoned into pre-selected pockets. Small businesses lose opportunities they deserved, communities receive overpriced or low-quality work, and the ultra-wealthy orchestrator sits untouched, insulated by layers of influence that hide their involvement. What makes bid rigging schemes so haunting is how normal they look. Meetings, proposals, signatures, sealed envelopes, every detail appears lawful, but behind the paperwork lies a silent agreement that twists fairness into fiction. allowing those with the most power to decide outcomes long before anyone else has a chance to compete. Transfer pricing abuse, illicit. Transfer pricing abuse is the deliberate manipulation of prices for goods, services, or intellectual property exchanged between companies under the same corporate umbrella, and when ultra-wealthy individuals attempt to exploit this system, the distortion becomes breathtakingly strategic and emotionally unsettling. At its core, transfer pricing is a legitimate financial practice used by multinational businesses, but when twisted illicitly, it becomes a tool to shift profits across borders, not to reflect real economic activity, but to hide income where taxes are low, oversight is weak, and scrutiny is minimal. The transactions look clean on paper, yet the intent behind them is anything but. Ultra-wealthy individuals who attempt to abuse transfer pricing don't need blatant tricks. They use sprawling corporate structures they already own, spreading subsidiaries across countries with carefully chosen tax laws. A product made cheaply in one place may be sold to another branch at a wildly inflated price. A valuable patent may be transferred to a company in a low-tax nation, allowing profits generated elsewhere to be reported where they barely face taxation. Each movement appears routine, backed by contracts and documentation that give the illusion of legitimacy. The deception lives in the numbers, not the paperwork. The emotional weight of this abuse stems from how quietly it steals from society. While ordinary individuals have taxes deducted from every paycheck, illicit transfer pricing shifts millions or billions beyond reach with the stroke of a pen. Public services lose the funding they rely on, small businesses face unfair competition, and communities feel the strain while those orchestrating the scheme remain protected behind corporate complexity. What makes transfer pricing abuse so disturbing is the way it hides wrongdoing inside normal business behavior. Everything looks compliant, everything looks justified, yet the truth is buried, carefully engineered by someone powerful enough to reshape financial reality in their favor. Royalty payment manipulation. Royalty payment manipulation is the distortion of payments tied to intellectual property, such as patents, trademarks, or creative works, to quietly shift money in ways that appear legitimate. And when ultra-wealthy individuals attempt to exploit this tactic, the manipulation becomes far more calculated, hidden, and emotionally unsettling. At its core, royalties are meant to reward creators or owners when their work is used, but in the hands of someone with immense resources, royalties become a financial pathway, a channel that can be inflated, redirected, or disguised to move large sums without attracting immediate suspicion. Ultra-wealthy individuals who attempt to misuse royalty payments don't tamper with small transactions. They build complex ownership structures where one entity holds the intellectual property and another uses it. By artificially raising or lowering the royalty price between these connected entities, they create the illusion of legitimate business costs while shifting money across borders or through opaque corporate layers. Each payment looks clean on paper, supported by contracts and licensing agreements that appear professional, yet beneath those documents lies a system designed to make money disappear from public view and reappear exactly where the orchestrator wants it. The emotional weight of this manipulation comes from how innocent it looks. Royalty payments are a normal part of business, routine, expected, even boring. But when distorted by someone with great wealth, they become a perfect disguise. Everyday people must justify every income source and expense, while a powerful individual can reroute millions behind jargon, paperwork, and intellectual property that no one fully understands. What makes royalty payment manipulation so haunting is its quiet sophistication. There's no chaos, no noise, no obvious sign of wrongdoing, just a stream of payments flowing through contracts, appearing reasonable to anyone who glances at them, while the truth remains hidden behind the polished language of intellectual property and financial strategy. IP valuation fraud. IP valuation fraud is the manipulation of intellectual property values to hide money, shift profits, or distort financial reality. And when ultra-wealthy individuals attempt to exploit this tactic, the deception becomes more polished, more carefully engineered, and emotionally unsettling. At its core, intellectual property, patents, trademarks, copyrights, proprietary formulas is intangible. It doesn't sit in a vault or reflect a clear market price. Its worth is based on projections, expert opinions, and subjective assessments. That ambiguity becomes a perfect hiding place. When an asset exists largely in the imagination, its value can be quietly stretched, twisted, or inflated far beyond what it's truly worth. Ultra-wealthy individuals who attempt IP valuation fraud do not rely on simple exaggeration. They use entire networks of consultants, shell companies, and related entities to legitimize the inflated numbers. A patent might be appraised at an absurdly high value by an independent expert who is anything but independent. A licensing agreement may be set at a price that makes no economic sense, shifting profits from one company they control to another that conveniently sits in a different tax or regulatory environment. On paper, everything appears compliant. In reality, the numbers tell a story designed to hide the truth rather than reveal it. The emotional weight of this fraud comes from how invisible it is. Ordinary people understand physical assets, homes, cars, land, but intangible assets exist in a fog ordinary eyes can't see through. When the ultra-wealthy manipulate IP values, they're not just altering numbers, they're rewriting the narrative of entire companies. Investors, employees, and communities believe in the success or stability those valuations represent, unaware that the foundation may be nothing more than strategically crafted fiction. What makes IP valuation fraud so haunting is how easily perception becomes reality. A number printed in a report can shape markets, influence decisions, and shift fortunes, even when that number was crafted to mislead from the start. VAT carousel fraud. VAT carousel fraud is the manipulation of value-added tax systems by creating a chain of fake or temporary businesses that repeatedly reclaim tax on goods that never meaningfully change hands. And when ultra-wealthy individuals attempt to exploit this scheme, the deception becomes more intricate, more insulated, and emotionally unsettling in its scale. At its core, a carousel fraud operates like a loop. Goods, often high-value, easily moved items like electronics or carbon credits, are sold through a series of companies, some real, some shell, until one company disappears without paying the VAT it collected. Another company in the chain then claims that same VAT back from the government. The cycle repeats, draining public funds through a system built on trust and paperwork. When someone with immense wealth steps into this world, the fraud evolves from sloppy manipulation to a coordinated network of entities spread across countries. The ultra-wealthy don't move boxes or shuffle invoices by hand. They use accountants, intermediaries, and companies that look completely legitimate, each step designed to blur responsibility. The carousel spins faster because wealth buys credibility. Banks trust them, suppliers cooperate, and authorities hesitate to question established names. The fraud becomes a ghost inside the tax system, feeding off loopholes no ordinary person could ever reach. The emotional weight behind VAT carousel fraud comes from who ultimately pays the price. The stolen tax revenue is public money, money meant for healthcare, education, infrastructure, and services that everyday people depend on. While citizens contribute through every purchase they make, someone with vast financial power quietly siphons those funds into private pockets through a scheme built on illusion. What makes VAT carousel fraud so haunting is its invisibility. On paper, everything looks like trade. shipments, invoices, payments. But behind the paperwork lies an empty loop where nothing real happens except the silent extraction of public wealth by those already standing at the top. Customs duty fraud. Customs duty fraud is the deliberate manipulation of import or export declarations to reduce, avoid, or distort the taxes owed on goods crossing borders. And when ultra-wealthy individuals attempt to exploit this system, the deception grows more intricate, more insulated, and emotionally troubling in its reach. At its core, customs duties exist to regulate trade and protect economies. They ensure that imported goods are declared honestly, taxed appropriately, and tracked transparently. But when someone with immense wealth chooses to manipulate these rules, the border, the place meant to separate legal from illegal, becomes a stage for misdirection. Ultra-wealthy figures who attempt customs duty fraud rarely deal directly with shipments or paperwork. They operate through complex supply chains, international logistics teams, or companies they control, turning the import process into a maze that hides truth behind layers of documentation. Goods might be undervalued on official forms, mislabeled as cheaper products, or routed through intermediary countries to disguise their origin. Every piece of paper appears legitimate, stamped, processed, and filed, giving the illusion that everything is in perfect compliance. Meanwhile, the real value and the real taxes owed remain quietly hidden. The emotional impact of this kind of fraud runs deeper than a simple loss of revenue. Customs duties fund infrastructure, healthcare, education, and public services. When ultra-wealthy individuals manipulate these systems, the consequences ripple outward, affecting people who depend on those resources. Small businesses compete honestly while watching powerful importers gain unfair advantage. Workers pay their taxes in full while corporations and wealthy actors quietly sidestep theirs. What makes customs duty fraud especially unsettling is how ordinary it looks. Containers move, paperwork passes, shipments clear. The world keeps spinning as if nothing is wrong. But behind the routine lies a calculated distortion, engineered by someone whose wealth allows them to bend the border itself into a tool of quiet advantage. Fuel tax fraud. Fuel tax fraud is the manipulation of taxes placed on fuel to secretly redirect money that should go to public revenue. And when ultra-wealthy individuals attempt to exploit this tactic, the deception becomes more engineered, more insulated, and emotionally unsettling in its scale. At its core, fuel tax systems rely on trust. Trust that businesses report the correct quantities, trust that taxes are passed along honestly, and trust that fuel moves through supply chains the way it appears on paper. But when someone with vast resources chooses to tamper with this system, that trust becomes a tool they twist into a shield for hidden profit. Ultra-wealthy figures who attempt fuel tax fraud don't siphon off fuel in trucks or alter numbers by hand. They build networks of companies, importers, distributors, wholesalers that make the fraud look like normal business. They may underreport fuel volumes, misclassify products to qualify for lower tax rates, or route fuel through shell companies designed to vanish before regulators realize taxes were never paid. To outsiders, everything appears legitimate: invoices, deliveries, transactions. The manipulation hides beneath layers of corporate respectability that make questioning the activity seem unnecessary. The emotional impact emerges when you recognize who pays the price. Fuel taxes fund roads, public services, and national infrastructure. When someone with extraordinary wealth secretly avoids these taxes, the cost shifts to ordinary citizens who have no choice but to shoulder the burden. It creates a quiet resentment, a sense that while regular people pay every cent at the pump, someone far more powerful is quietly removing themselves from the rules everyone else must follow. What makes fuel tax fraud so haunting is how normal it looks. Fuel still flows, receipts still print, Businesses still operate, yet behind that everyday activity lies a hidden rerouting of money that shouldn't have moved, money taken from systems meant to support everyone, redirected by someone wealthy enough to bend the process into silence. Environmental credit fraud. Environmental credit fraud is the manipulation of carbon offsets, renewable energy credits, or other sustainability-linked certificates to create the illusion of environmental responsibility while secretly profiting from deception. And when ultra-wealthy individuals attempt to exploit the system, the betrayal becomes sharper, more calculated, and emotionally disturbing. At its core, environmental credits are supposed to represent real-world actions, planting forests, reducing emissions, generating clean energy. But because these credits are abstract, often traded on paper instead of inspected in person, their value is built on trust, and trust becomes the perfect shelter for those who want to twist it. Ultra-wealthy individuals who attempt to commit environmental credit fraud rarely do something as simple as selling fake certificates. Instead, they use complex networks of companies, shell entities, and international registries to create confusion around what has actually been done. A forest preservation project might exist only in a report, not on land. A renewable energy site may be exaggerated, duplicated, or completely fabricated. Audits can be influenced, paperwork polished, and credits generated from projects that never delivered the environmental impact they promise. On paper, it looks like progress. In reality, nothing changed except the flow of money. The emotional weight of this fraud is immense because it exploits something deeply human, the desire to protect the planet. Individuals, companies, and governments buy these credits, believing they are doing something meaningful. Meanwhile, the ultra-wealthy orchestrator profits from empty gestures disguised as green initiatives. The deception harms more than investors. It harms the environment itself by masking inaction behind a veneer of responsibility. What makes environmental credit fraud so haunting is the contrast between appearance and truth. Reports filled with hopeful language, glossy sustainability claims, and promises of ecological change can hide a system built on falsified impact. And when immense wealth fuels that illusion, the world is left believing progress is happening while the planet quietly pays the price. Carbon credit laundering. Carbon credit laundering is the manipulation of environmental credit systems to hide, inflate, or redirect money behind the mask of climate responsibility. And when ultra-wealthy individuals attempt to exploit it, the deception becomes more polished, more protected, and emotionally unsettling in its impact. At its core, carbon credits were created to fight pollution. Companies or individuals fund eco-friendly projects to offset emissions. The idea sounds noble, reduce harm by investing in healing. But when someone with immense wealth misuses this system, the very concept of environmental responsibility becomes a tool for invisibility. Ultra-wealthy figures who attempt carbon credit laundering don't plant fake trees or forge certificates by hand. They operate through consultants, intermediaries, shell companies, and international markets, where oversight is limited and verification is inconsistent. Credits can be bought, resold, repackaged, or inflated far beyond their real environmental value. A single credit can be counted multiple times, tied to projects that barely exist, or funneled into entities controlled by the same individuals orchestrating the scheme. On paper, it looks like climate action. In reality, it's a financial smokescreen. The emotional sting comes from the betrayal it represents. People care deeply about the environment. They recycle, reduce waste, buy greener products, and trust that carbon offset programs are part of the solution. Meanwhile, someone with immense wealth may quietly exploit the same system to hide profits, move money, or polish their public image with eco-friendly lies. The world believes emissions are being reduced, forests protected, and climate efforts funded. Yet behind the glossy reports, the truth can be empty. What makes carbon credit laundering so haunting is how easily good intentions can be twisted. A system built to save the planet can be turned into a silent channel of manipulation, where environmental virtue becomes the perfect camouflage for hidden financial movements that no one is meant to question. Commodity market manipulation. Commodity market manipulation is the intentional distortion of prices for essential goods like oil, metals, grain, or energy. And when ultra-wealthy individuals attempt to exploit this arena, the impact becomes global, invisible, and emotionally unsettling. At its core, commodity markets are supposed to reflect real supply and real demand. Prices rise when resources are scarce and fall when they are plentiful. But when someone with immense wealth chooses to interfere, they can bend these natural forces, turning basic human necessities into tools of personal power. Ultra-wealthy figures who attempt to manipulate commodity markets don't do it with obvious moves. They operate through hedge funds, trading desks, shell companies, or large holdings that allow them to push prices in a specific direction without drawing attention. By hoarding supply, creating the illusion of shortage, or flooding the market to spark panic, they can make millions react to conditions that never truly existed. Traders, governments, and industries respond to these signals as if they're real, unaware that someone wealthy enough to tilt the scales may be pulling strings behind the scenes. The emotional weight of such manipulation is profound because commodities aren't luxury items. They're the backbone of daily life. When prices shift artificially, families feel it in grocery stores, gas stations, and utility bills. An ultra-wealthy individual attempting to influence these markets isn't just playing with numbers, they're affecting the cost of living for millions of people who have no idea their hardship was engineered for someone else's gain. What makes commodity market manipulation so disturbing is how quietly it happens. Charts move, analysts speculate, headlines try to explain sudden spikes or drops. Meanwhile, the true cause may be a calculated decision made in a boardroom, far removed from the people who will feel the consequences. And in that silence, the ultra-wealthy can turn global resources into a stage for profit, leaving the world to absorb the aftermath.